made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
Welcome back to the European Market Open. 10 minutes into our European session, and things look fairly mixed this morning, actually, for European equity markets. Let's dive into some of the individual movers, and we'll get a sense of why things are so mixed, perhaps. We are in the heart of earnings season, so plenty of individual corporate stories to focus on. Let's go to the car maker Stellantis. That stock is up by 3.3%. The company increasing its operating margin targets, and we've heard from others in the sector about the second half of the year, the impact of the chip shortages and higher raw material costs, and that is weighing on some like BMW, but today Stellantis going in a different direction, up by 3.6%. Let's talk about SocGen, the French banking business, also in focus this morning. We've included that in our movers today. They are lifting their outlook over at SocGen. The stock is up by 2.9%. Loan worries seem to be fading at that business, and that's a trend we've seen from a number of European banking businesses, that the level of worry and the level of provisioning that then resulted in the first quarter was perhaps not needed into the second. And so we've seen some of that benefit coming through on European banks, and equities rebounding, also helping SocGen. Let's go to Prosus. This is not an earnings story. This is a read across from Tencent in China. So Prosus, of course, owns a stake in Tencent over in China, and the games maker in China is under pressure today after we've seen those reports, negative reporting from Chinese state-backed media around the gaming industry, and as a result, Prosus down by 4.9%. So earnings season is well underway. A slew of corporate results are mostly proving that growth is continuing. Let's talk about the earnings season then. Geraldine Sundstrom, portfolio manager for asset allocation at PIMCO, is still with us. Geraldine, you gave us a few of your thoughts just a moment ago about the bottlenecks and the low inventories, and how you actually think that might play, it might be a positive for some corporates, because it means that the growth story lasts longer. Maybe the top of it is taken off in terms of the peak, but it lasts longer, and that maybe is a strength. What do you make of the conversation around inflation, though, and the cost of inputs? Because that does seem to be a narrative that many companies are picking up on.
Yeah, so a bit of the same story. It might be higher for longer. I think Chairman Powell said it very well last week, where it's a bit uncertain for, how long this bottleneck will take to ebb. And therefore, inflation might be, a little bit higher for a little longer. However, we know the direction of travel. Those bottlenecks will eventually get better. Much longer than we thought previously. It looks like the second half is still going to be complicated, especially with what's happening with shipping. We know there that the bottlenecks are getting even worse. They are not improving, and we're coming into the Christmas stocking session, so unlikely to see a massive drop anytime soon. However, coming into 2022, things should be getting better. And the key point here is that central banks seems to be willing to accommodate that. They understand that it takes time, and therefore there are companies that are going to enjoy this rent, that are going to make those high margins, certain suppliers, and this is going to create pockets of inflation. But we certainly do not believe that this will become a process, that it's going to broaden as something that is self-feeding. We know that come 2022, the situation is going to improve. But for the rest of 2021, inflation is likely to be a little bit higher than what everybody thought.
OK, so inflation is a little higher than what we thought, Geraldine, but does it turn into something more structural and long-lasting? Is it possible that all of the peak in inflation, all of the spike up in inflation is unwound, and we don't see those kind of percentage changes into next year at all, or what happens on pricing? Where do you think we head?
Well, from here, it would be difficult to see prices continuing to increase relentlessly at the same pace. So most likely things could slow down. Price might not mean revert to where they were before, and that's going to be pretty clear in some of the strategic part of the net zero economy. Demand there is likely to remain robust for a good decade or so. So it's going to take a while to normalize this. What the central banks are going to be very careful about, and that's going to be sometime into 2022, is that if this translates into wage hike, much more than just the one-off that we're seeing now, but constant wage increase, and that feeds into a process that is self-feeding in terms of inflation, then the Fed has made it very clear they will react and they will not let this happen. So for the market, it's going to be weighing all of this, but this is going to play out over quarters. We will certainly not have the answer right here, right now. And we know there's patience. So I don't think this is something the market should overly be concerned right now and observe this. I mean, certainly we've seen the prices of oil has calmed down. The price of certain commodities have started to stabilize, find a new level. I think this is what we have to look at. And wages, yes, have increased. There are labor shortages. We've seen wage hikes a little bit, especially in the US, but I think it's a more broad-based phenomenon. The question is, what happens in 2022? Are we seeing yet again, those wage hikes? Or this was more of a one-off and then we normalize? And certainly at PIMCO, the view would be that 2022 is much more a year of normalization. There will remain some pocket of inflations that will be worth harvesting, but this will be very specific sectors where secular demand is extremely strong.
OK, if we do see some normalisation then around inflation, and I take totally on board your point about prices not mean reverting, and maybe some normalisation around wages next year, Geraldine, where does that leave the central banking story? And I'm thinking in particular of the Fed and the extent to which normalisation is possible from the Fed next year.
Sure. So we think that, tapering is going to be announced, in the autumn and likely to start in early 2022. The Fed will take its time to taper, which means that when it comes to rate hikes, which is what everybody is worried about, it will be probably late into 2022 and possibly early 2023. So we're talking quite a bit out in the future, meaning that generally speaking, given the fact that growth is above trend and well above trend for quarters to come, this remains very accommodative. It's an environment where companies should be thriving, where profits should be robust, and therefore it's a good backdrop for risky assets.
Geraldine, thanks very much. Thanks for speaking to us today. Really nice to talk to you. Geraldine Sundstrom, Portfolio Manager for Asset Allocation at PIMCO. And Geraldine will be continuing her conversation with us on Bloomberg Radio at 8:50. That is UK time. Let's get a Bloomberg Business Flash. Here's Laura Wright.
Thanks, Anna. BMW has joined other car makers in reporting strong earnings dampened by warnings about the global chip shortage. Earnings before interest and tax surged to €5 billion in the second quarter, well ahead of estimates for €4 billion. Meanwhile, Stellantis, formed from the merger of Fiat Chrysler and PSA Group, raised its full-year profitability forecast substantially. Strong demand and pricing saw the company beat estimates in its first earnings report. Credit Suisse has sold $3.75 billion of bonds as it recovers from losses stemming from the collapse of Archegos Capital. The lender issued the debt in three parts with durations of 2 and 5 years. Credit Suisse's exposure to Archegos cost it at least $5.5 billion and prompted changes including a pause in buybacks and dividend cuts. The UK government is to assess £6.3 billion takeover of defence and aerospace manufacturer Meggitt. Bloomberg understands ministers may seek assurances from US buyer Parker Hanfin on preserving jobs, though no decision has yet been taken to intervene on the deal. Reese Witherspoon has sold a majority stake in her production company Hello Sunshine to a new firm run by former Disney executives. The deal's also backed by Blackstone and is said to value the company at about $900 million. Witherspoon will continue to help oversee day-to-day operations and hold significant equity. That's the Bloomberg Business Flash. Anna.
Thanks very much. Laura Wright here in London with your business update. Coming up on this programme then, spiritual opium. That's what an offshoot of China's official news agency has labelled video games. Tech shares dived in China, with Tencent plunging as much as 11% earlier in session. We go live to Hong Kong.
Welcome to FBS, the worldwide broker with over 16 million clients, billions of orders, over 400,000 partners, and more than 150 countries of presence. Why do people choose us? Trade with MT4, MT5, or even better, try FBS Trader Platform for more comfortable trading. Access your personal area through the website or mobile app anywhere you want. Check out the Copy Trade app, where you can earn by simply copying the moves of top traders. Invest easily, profit big. Choose out of a wide list of local payment systems to manage your funds with ease. In case you've got any questions, FBS support teams got your back 24/7. FBS is trusted by professionals. Starting from January 2020, the broker is an official trading partner of one of the world's most renowned teams, FC Barcelona. FBS holds many great contests, part of which aims to charity. Traders and partners can realize their dream or help someone to realize theirs. Our closest friends in the loyalty program get profits and valuable gifts for doing what they enjoy, trading. Being a partner in FBS means you can get a solid extra sum of the partner bonus, among other benefits. Worth a look, right? Add fantabulous events and parties for partners all over the world, and consider it a real deal. Trade with a reliable broker. FBS, always by your side.
Find your perfect breakfast plus one. I'm wheaty. I've got added manganese, so I'll help try and keep you trim. Let's do breakfast.
It's oats and honey. I've got added fiber, but no time for chit-chat. I'm just what you need.
I'm cranberry, C for short, with multigrains for energy. Pick me.
Soy and linseed's my name. I'm high in omega-3. Peace.
And it's me, WWP Whole Wheat Bran. I'm stacked with fiber. Let's hook up for brekkie.
Seems to be a really tough situation, better than almost anyone else.
We've worked hard on the supply chain. There's no question there's a lot of work to do in the supply chain for semiconductors. And we're happy that we were able to exceed our second quarter guidance, as well as, guide up for the rest of the year.
Welcome back to the European Market Open. 22 minutes into a trading session that is busy dealing with a number of forces. The earnings story, a little bit of weak momentum from the United States overnight, and some negativity around the gaming sector in China. All of that adds up to a flat to positive session now for European stocks. Let's think about what's coming through from China then. Chinese tech is once again in focus. This time it's social media giant Tencent at the centre of things. The stock diving today after an offshoot of China's official news agency criticised video games. For more, Bloomberg's tech and gaming reporter Zheping Huang joins us from Hong Kong. Zheping, really good to have you with us again then. So what did state media say? What is the criticism that's been made this morning?
Right. So earlier in the morning, we saw an article from a newspaper owned by Xinhua, which is China's top news agency. In that investigative piece, the reporters argue gaming addiction is a serious problem among China's youth right now. And the article called for stricter control of the time and the money kids can spend in games, especially in Tencent's popular titles like Honor of Kings. The article compared online games to spiritual opium and electronic drugs. And although we've seen the online version of the article was pulled offline, but the print version still exists. And just a couple hours earlier, Tencent came up with a brief pledge where it says it will further control and limit the time among minor gamers on its games. And it also called on the whole industry to explore the possibility of banning games altogether for kids under the age of 12.
Right. And what's happened in the past then, and what regulations could come next? You give us a sense there of Tencent already trying to get ahead of regulation.
Yeah, that sounds like the case. Tencent reacts very quickly this time, as it did in the past. Because back in 2018, China also cracked down on gaming. Back then, the regulators freezed the monetization license for new gaming titles for most part of that year. And since then, Tencent and other companies like NetEase and Xingdong Doc Inc., they have came up with all sorts of measures to restrict or detect minor users on their platforms. But what we've seen today might be a signal that more might be in the works and might come in the coming weeks or months.
Okay, thank you very much. Thanks, Xiaoping Huang. Thanks for joining us, our tech and gaming reporter in Hong Kong, taking us back through history and some other examples of where we've seen Tencent coming under pressure, the gaming sector coming under pressure. We'll continue to follow that story for what it means for the gaming sector and also for the broader regulatory narrative coming through from China, one we picked up on a lot last week and continue to watch very carefully. When we come back, we'll be talking about the banking sector. We've heard from Standard Chartered today, buybacks, and a dividend at Standard Chartered. We'll hear exclusively from the bank's CEO, Bill Winters, after the company put forward its results. Standard Chartered going on to talk about China and Hong Kong and what they see there. China's connection to the world is increasing. Hong Kong is a thriving commercial centre, a hub for China's capital markets. So clearly some interesting conversations around those geopolitical pulls, perhaps, to be had with Bill Winters. We'll certainly bring you highlights from that conversation shortly, the Standard Chartered CEO. In terms of the European equity market picture, this is what we have. The DAX underperforms a little, but we have elsewhere European equity markets making moves to the upside, up by 0.1%. Stocks Europe 600 as we digest a host of diverse earnings themes, I suppose. We've got some good, some bad, some fairly neutral. We'll be back with more on the markets next. This is Bloomberg.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tianyi Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance and more.
2022年完成空间站的在轨建造，建成国家太空实验室。之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station.
出发，是，敬礼。
China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. Half an hour into our European trading session, and this is the picture for European stocks making moves to the upside. Broadly speaking, the DAX down by 0.1%. Elsewhere, we see markets moving higher. The CAC 40 in particular up by 0.7%. The banking sector, as we look at the GRR, you'll see the banking sector not doing too badly. And one of the stocks in there is a French banking business, which is up by 3.8%, which is going to help the CAC 40. So that is SocGen, up by 3.8% today. We also see gains for the energy sector, and so keeping that in mind, BP is up by 2.5% after increased its dividend and increased share buybacks. So that's certainly a big theme for the energy space right now. To the downside, we see technology stocks bringing up the rear. Process is one of those, and Infineon Technologies. So Infineon weighing on the DAX. That may be why we're seeing the DAX underperforming a little bit. And actually, Process takes us on to the next story I just want to mention. Process has a shareholding in Tencent over in China, and Tencent is very much in focus today because of some commentary in the Chinese state-backed media that has been less than positive. It's been negative about Tencent, about, well, specifically around gaming and children playing computer games. So interesting to note then that Tencent is still down by just shy of 7%. And we're just getting some more headlines around Tencent saying it's postponing its digital conference, which is scheduled for August the 18th to 19th. They're citing pandemic prevention for the conference delay, which is interesting in the context of Tencent and what messaging it's ready to give to the market, given the political pressure it seems to be under. But it's also interesting in terms of the Chinese fight against the Delta variant. If we are going to see events being cancelled, that is something that we will keep on our radar. Let's get a Bloomberg First Word News update then. All the top stories we're covering here at Bloomberg this morning. Here's Laura.
Thanks, Anna. The UK changed the National Health Service mobile app so that fewer people will be told to self-isolate in an effort to limit disruption from the so-called pingdemic. Under the changes, only those who have come into contact with an infected person within 2 days prior to a positive test will be alerted, rather than within 5 days previously. A surge in pings has caused havoc for companies as staff were forced to stay at home. IMF members have approved the biggest injection in the fund's history, $650 billion to help countries deal with mounting debt and the fallout from the pandemic. The creation of the reserve assets, known as special drawing rights, is the first since $250 billion was issued just after the global financial crisis in 2009. The US has reached President Biden's goal of 70% of adults being at least partially vaccinated against the coronavirus, about a month later than planned. Meanwhile, San Francisco and surrounding cities are reinstating mask requirements in indoor public spaces, regardless of vaccination status. New York City is strongly recommending masks indoors, but without mandating it. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London. Let's get back to the bank earnings story. And Standard Chartered, the bank is buying back $250 million of shares and is planning a small dividend. That's after reduced credit losses helped Standard Chartered beat on profits in the second quarter. The company's CEO, Bill Winters, spoke exclusively to Bloomberg's Rishad Salamat.
We had a stellar first quarter. Things actually slowed down quite a bit in April, picked up in May, picked up some more in June. And I would say the level of business activity continues to remain pretty robust. So we don't see a big fall off. There's always an element of seasonality, and we know that the August in particular tends to be a slow month. We'll see if that comes through this year. But generally, I think that the business momentum feels very good.
How does the Delta variant play into this and your fears therein?
You know, we live in fear of what comes next. We have a big operational hub in India. Our Indian business was hit very, very hard. But in the first half of the year, our Indian results are extremely strong. So good income growth, good cost
percentages.
20% increases in the key business lines in India. And that's been very encouraging. So the Indian market has demonstrated a tremendous resilience through some very difficult times. But, it's not over. And, we're obviously going through tough times in Indonesia right now, Malaysia, some of our African markets. And while so far relatively little of this has translated into actual loan losses, it's still possible that could manifest itself. And at some point, governments will also find it a little bit harder to respond to all this and to keep things on the right track. But I'll say so far, so good.
How would the bond repurchase program in the US being reduced, tapered, etc., affect your business in particular as we move towards a maybe a higher interest rate, a normal environment?
I mean, we're all focused on where interest rates are going. We're most sensitive to the short-term interest rates, but it's also easier for us to make money if we have a steep yield curve. And relative to what the market was expecting when we last spoke, or when we spoke in a detailed way in February, the yield curve is quite a bit steeper, despite the fact that obviously longer-term rates have come back down. If the Fed begins to taper and we get an easing back up of 10-year rates or longer-term rates, which there's no sign of right now, I will say, right?
I mean, 1.17% for a 10-year yield is incredible.
There's no sign. But I think that also reflects a fundamental concern about the economic malaise, that maybe the very, very, very good times are petering out a little bit, which may be true. But like we've seen it in China. China boomed in the early post-pandemic recovery days, and now it's normalizing. Well, that's normal, right? And that's fine. Normal is fine by us. I think it will help to avoid some of the bubbles that could come across anyway. And hopefully we'll get back to a little bit more normal yield curve over the next few years.
But taxpayers got to pay this bill back, haven't they? Ultimately, they've got to foot the bill as to what's happened fiscally speaking. So that, of course, dovetails into the IMF also talking about and downgrading growth forecasts in this part of the world. How do you make provisions for that, and how are you seeing it?
Yeah, governments do have to pay back the money that's been borrowed. But the cost of carrying that debt is very low, right? Because most of that was borrowed at close to zero interest rates, or at zero interest rate. Or if you're in Europe, it's borrowed at negative interest rates. So the rush to pay that back is not too pressing. But we would expect to see a normalization of economic activity. So we've had a rolling boom on the back of stimulus and COVID recovery, and that's going to ease. The U.S. stimulus is going to ease up. The Chinese stimulus is already easing up, and that will normalize global growth.
That was the Standard Chartered CEO, Bill Winters, speaking exclusively to Bloomberg's Rishad Salama. Let's stick with the bank earnings, get a wrap of the bank earnings season that we've had so far. Jonathan Tice joins us, European Bank Senior Analyst at Bloomberg Intelligence. Really nice to speak to you then, Jonathan. So Standard Chartered announced a buyback. What are the key takeaways from the numbers from that business?
Good morning. Pretty disappointing, I think, because if you look at Standard Chartered, we're again being reminded there's no growth this year. It's next year that we're looking for some growth. They missed on costs again, and I think had the stock not been down 3%, underperformed the sector by about 25% year to date, it would be down today. But there's a lot in the share price now. But from my perspective, we're just being asked to wait on the revenue side. They're guiding to, well, costs may actually even miss our target for this year if we need to put aside a bit of variable comp. So net, they seem to be playing a waiting game, whereas we'd much rather see them aggressively attack the cost base because, I mean, this is an emerging markets bank that generates a return on capital single digits, which in the credit environment we're in now is just very disappointing.
OK, and then let's contrast that with Societe Generale. I say contrast because I see that the share price is up by 4.9%, so something's clearly going well for them in terms of the share price reaction. Jonathan, what did you make of SocGen this morning?
Well, I mean, it was one of our focus ideas earlier in the year. They've really turned the ship around. It's up nearly 60% year to date, and they're ticking all the boxes. The equities trading franchise is massive beat today and a very good recovery. Again, decent capital. French retail's turning around. So you've got two stocks that optically have been pretty cheap, but one of them is addressing the cost base, is actually returning to growth. They've both given buybacks, but the buyback is far more meaningful for SocGen because they've got more excess capital now, which is something I never thought I'd be saying sort of 6-12 months ago. So two completely different investment theses.
And what are the things, as we look back then on a lot of the earnings season, which has now happened, and we've heard from a number of banks across Europe, what are the themes that are emerging? I mean, a number of businesses took provisions in the first quarter of the year that maybe then seemed excessive as the year went on. What's been the story for you?
Well, I mean, we all knew that consensus was deliberately high and that provision write-backs would be coming, but we just didn't know to what size. So that's played out very nicely and continues to play out. But all it means is that 2021 profits are flattered. The question is, what's the revenue run rate into 2022 and who's doing a good job on costs? And you've also got a capital return where you've got a Barclays buyback, you've got UniCredit, BBVA, some banks that will drive earnings growth by running down excess capital, which is a positive. And then you've got some banks that continue to struggle on the top line and aren't doing enough on costs. And I'd cite Standard Chartered as a prime example of that. So the sector's trading kind of in the middle of the historic valuation range. And at the moment, we're sort of running out of catalyst quite quickly.
Jonathan, thanks very much. Thanks for joining us. Jonathan Tice, European Bank Senior Analyst at Bloomberg Intelligence. Thanks for wrapping up the bank earnings season for us. Coming up on the programme, we'll think about a different sector, the oil sector and energy. BP shares gain as it joins its big oil peers by increasing dividends and share buybacks in a bid to woo increasingly climate-conscious investors. We hear from the CEO, Bernard Looney. That conversation will bring you highlights from it next. This is Bloomberg.
What you said was we need to make them in America. Does that include overseas companies making them if they have the plant in America?
I would certainly be in favor of them having operations in America, absolutely. You know, Samsung, TSMC, there are companies that are in allied countries, and you know, we certainly want them operating in America and producing chips in this country, yes.
So we have a significant chip issue, but there are other supply chain issues as well. As I know you're monitoring what's going on. Where have you seen other problems in the supply chains right now in the United States that need to be addressed?
Particularly in home building supplies, you know, lumber and all the related supplies, glue, adhesives. And you see it playing out. You know, home prices are high. If you go to Home Depot or Lowe's, you'll see prices are a little bit high. So, and that's all because of the lack of supply, just disruption.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kayleigh Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Welcome back to the European Market Open. 43 minutes into our Tuesday session, and things improving a little. The Xetra DAX now just managing to eke out some positive territory. The CAC 40 is doing very well, thanks in part to the banking sector, up by 0.75%. Let's get a Bloomberg Business Flash. Here's Laura.
Thanks, Anna. BMW has joined other car makers in reporting strong earnings, dampened by warnings about the global chip shortage. Earnings before interest and tax surged to €5 billion in the second quarter, well ahead of estimates for €4 billion. Meanwhile, Stellantis, formed from the merger of Fiat Chrysler and PSA Group, raised its full-year profitability forecast substantially. Strong demand and pricing saw the company beat estimates in its first earnings report. Smiths Group has struck a deal to sell its medical division to a subsidiary of private equity firm TA Associates for an enterprise value of $2.3 billion. UK-based Smiths Medical makes products including catheters and syringe pumps for hospitals. Reese Witherspoon has sold a majority stake in her production company Hello Sunshine to a new firm run by former Disney executives. The deal's also backed by Blackstone and is said to value the company at about $900 million. Witherspoon will continue to help oversee day-to-day operations and hold significant equity. That's the Bloomberg Business Flash. Anna.
Thanks very much, Laura Wright, with your Business Flash. Let's stick with the corporate news flow. And BP is surging this morning after joining its big oil peers in increasing dividends and share buybacks as higher crude prices boosted profits. The oil majors, with the notable exception of Exxon, are raising returns as they move past the worst of the pandemic slump. That's in a bid to woo investors who are becoming increasingly wary about the future of fossil fuels in a changing climate. Earlier, I spoke to the company's CEO, Bernard Looney.
I think our team has done a great job in the past quarter, and we have taken the decisions that you've just talked about, and they're really based on three things. Number one, Anna, it's the underlying performance of the business, which, if I can say, has been strong in the quarter. We delivered our cash cost savings target 6 months ahead of plan. We actually had the strongest convenience result in this quarter in our history. So the underlying business, first and foremost, is performing very well. Secondly, Anna, the balance sheet continues to strengthen. This is the fifth quarter in a row where net debt has come down now to $32.7 billion. And thirdly, it's about our confidence in the outlook for the environment. So when you look at it from that dimensions, they're the reasons that we've taken the decision that we've taken. $1.4 billion worth of buybacks in the third quarter and a 4% rise to the dividend. And actually, as we look out, Anna, over the next 5 years, at an oil price of around $60, we have the capacity to raise that dividend annually by about 4%, as well as, by the way, $1 billion a quarter approximately of buybacks. And that's about $4 billion a year at $60, which is probably 5% of the market cap of the company today. So that's really what this is about.
OK, and you've increased the dividend and you're doing this share buyback. I think you've said in the past that any excess cash would go in share buybacks and not in an increase in the dividend. So is this a change of position on the dividend? Why that change in thinking?
So our financial framework, Anna, remains exactly the same. There are 5 elements to it, and the first priority in our financial framework is a resilient dividend, and that absolutely remains the case today. And priority number 5 is that we'll distribute excess cash, 60% of excess cash, to our shareholders in terms of buyback. What you're seeing around the dividend is really a story of confidence. It is a story of confidence in the underlying performance of the business. It's the confidence in the balance sheet. And 12 months on from when we laid out our strategy, of course, the world's in a very different place with the environment. Global GDP is now back to pre-pandemic levels. The vaccines clearly are working. People are back flying, not to the same extent, but they're back flying. People are back driving. Not alone that, but we're also seeing OPEC Plus has maintained strong discipline. And then, Anna, in the US shale business, which has typically been a huge responder to prices, you're seeing a different business model emerge there, where cost of capital is higher and investors and operators are being much more disciplined and focusing on cash. So it is a very different world, and that's why we've gone ahead and made the decision that we've made around the dividend.
That was the BP CEO, Bernard Looney, speaking to me earlier on the programme, talking about the reasoning behind the increased dividend this morning. Coming up here on this programme, on the European Market Open, we dive back into the markets and discuss the spillover from Tencent's plunge on fears that China's next crackdown could hit video games. We're certainly seeing the impact on Prosus and Naspers. We'll get into that conversation next. This is Bloomberg.
valuations, particularly sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. 8:51 here in London, so 51 minutes into our European session, and things looking a little brighter perhaps, certainly in the Paris market, up by 0.75%. The DAX just managing to eke out gains despite some chip stocks moving to the downside. Paris boosted by bank earnings, the London market boosted by oil majors. Let's get to Ven Round from our Markets Live team, who can join us and talk us through some of the latest themes in these markets. Ven, good morning to you. So one of the things we're tracking very carefully is, of course, the fallout from the Tencent story that's been developing through the Chinese session, weakness in the Tencent share price, then flowing through into European owners of Tencent. What do you make of things?
Morning, Anna. I think the critique against online gaming in the Xinhua outlet shouldn't really come as a surprise, because if you see the recent moves, China has cracked down on e-commerce, retailing companies, and in general, and the online education industry in particular. This may be an offbeat concept to the more advanced markets from a regulatory perspective, but Chinese policymakers are keen not to just expand their economy, but also they want to shape values in their society. If you look at the wording of that article, it says that no industry or sport should prosper by eradicating an entire generation. It's very, very Confucian in its tone. And that's the reason why the European market won't be adversely impacted, because it's so Chinese in its value, and it's kind of, as I mentioned, it's an offbeat concept to the more advanced market from a regulatory perspective. Now, European lawmakers aren't likely to take such an approach, and therefore the European markets are holding up a lot better. But gaming and tech stocks in the US may be affected as they open.
Right, yeah, interesting. We're just getting some lines coming through from the China News Service, publishing commentary on online gaming and suggesting that action will be taken, saying it's immoral to blame schools or game companies or parents alone, and suggesting that all three need to cooperate in guiding children. So just to your point about the way that China is then going to clamp down on gaming companies and put guardrails around the use of these businesses by children. Interesting one to watch. I mean, there are regulatory impulses of that nature in Europe, but they are very different, as you point out. Let me ask you about FX markets then, Ven. The Australian market very much in focus. The Aussie dollar, the biggest G10 gainer, I think. We heard from the RBA, whilst many of the viewers of this programme were soundly asleep. So take us through what the story was there.
Well, the Aussie is on the leaderboard, as you mentioned, because the RBA's guidance was less dovish than it has been in the past few months. For one thing, it stuck to its plan to continue with its taper of bond purchases. For another, it has raised its forecast for underlying inflation for 2023. Both were quite unexpected, which is why we see the Aussie gaining. But even so, the Aussie may struggle to hold on to its gains beyond today. Why do I say that? Because today's, despite a slightly hawkish slant, the RBA is still one of the more dovish G10 central banks. B, the Chinese economy is slowing, which will affect growth in Australia. And we also had some hawkish tones from the New Zealand Central Bank today, cracking down on the property market. So, in other words, the New Zealand Central Bank is definitely likely to raise rates a lot sooner than the RBA, which makes the Aussie Kiwi more vulnerable in the coming weeks.
And let me just stick with FX. You've been focused on the Turkish lira as well. I saw the Turkish July inflation numbers coming in higher than expected, and then we see the lira gain. Is there an expectation that rates would rise as a result of the higher inflation print? What's the narrative here then, Ven?
You're absolutely right to point out the irony of, the inflation rising and the currency also gaining. I don't think their expectations are so much that they will raise rates, but I think the expectations are that the readings raise conviction that with inflation so high, the Turkish central bank can't afford to cut rates, even if it would like to. Investors are wary that they may prematurely cut rates after President Erdogan had said earlier that policy loosening may be possible in the summer. So despite its rally today, the lira is trading at a considerable discount to fair value, which is around 750 levels. So that discount may yet prevail because investors may still want an adequate political risk premium to hold the lira. So I think that's how the lira is going to play out. I mean, the higher the inflation reading, the stronger will it be because the CBRT may not do anything yet on rates.
OK, thanks very much, Ben. Really good to speak to you, Ben Round from our Markets Live team. Thank you very much for spending time with us on the European Market Open. Surveillance Early Edition is up next. Interesting to note that Evolution Gaming is moving to the downside in Stockholm. Maybe there is a little read across there. This is Bloomberg. How do you assess the sector as a whole? Is it making a better case for itself at the right price at this point?
Most of the big hedge funds, most of the people that have been growing, have been delivering very good performance. We have, but so is a number of the peers. You know, it is definitely the hedge fund business is getting more about the large getting larger and generating more performance, being able to hire the best people, thereby generating better performance, thereby getting larger. So when you look at the performance of the largest, say, 20 or 50 hedge funds, the performance has been pretty good over a number of years, and the inflows have been pretty good. You know, this is another quarter of positive inflows for us. I think one of the bits you're seeing at the moment is every client is worried about inflation. When they say they're worried about inflation, what they really mean is, I own a load of bonds, is that going to cause me a problem?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think the dramatic increases we've seen in terms of precious metals, steel and other commodities, I don't see that coming through to customers in huge measure later this year.
We want to strongly recommend that people wear masks in indoor settings, even if you're vaccinated.
We had a stellar first quarter. Things actually slowed down quite a bit in April, picked up in May, picked up some more in June. And I would say the level of business activity continues to remain pretty robust.
This is Bloomberg Surveillance, Early Edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. Not playing games, Tencent slips the most in a decade after Chinese state media decries video gaming as spiritual opium. Bringing back the buybacks, Standard Chartered announced it will repurchase $250 million of shares and pay out a dividend as profit jumps. Our exclusive interview with the CEO coming up. And big oil's big beat. BP joins its peers in increasing buybacks and dividends as higher crude prices boost the bottom line. We'll hear from Bernard Looney. But it's not necessarily animal spirits dominating this market, more so spiritual opium, or the phrase the Chinese media used to describe what's happening with video games. So a nervous market as we got a handoff from Asia that was concerned about more regulation. Still, we're looking at Euro stocks 600 up 0.3%. Similar story when it comes to U.S. futures after falling yesterday. So perhaps as some of the stronger earnings pictures carrying us through. Yes, we're about a basis point higher on your nominal 10-year yield, but that doesn't tell the story of yesterday of this huge flight into the bond market. Everybody using every opportunity they can to send yields lower. So right now hovering around a February low. Let's go ahead and get straight into earnings, though. Standard Chartered continuing the strong earnings season for Europe's banks. It's buying back $250 million of shares and planning a small dividend. That's after reducing credit losses, and those helped the Asia-focused lender beat on profit in the second quarter. Its CEO, Bill Winters, spoke to Bloomberg's Rashad Salamat.
We had a stellar first quarter. Things actually slowed down quite a bit in April, picked up in May, picked up some more in June. And I would say the level of business activity continues to remain pretty robust. So we don't see a big fall off. There's always an element of seasonality, and we know that the August in particular tends to be a slow month. We'll see if that comes through this year. But generally, I think that the business momentum feels very good.
How does the Delta variant play into this and your fears therein?
You know, we live in fear of what comes next. We have a big operational hub in India. Our Indian business was hit very, very hard. But in the first half of the year, our Indian results are extremely strong. So good income growth, good cost
percentages.
20% increases in the key business lines in India. And that's been very encouraging. So the Indian market has demonstrated a tremendous resilience through some very difficult times. But it's not over, and we're obviously going through tough times in Indonesia right now, Malaysia, some of our African markets, and while so far relatively little of this has translated into actual loan losses, it's still possible that could manifest itself. And at some point, governments will also find it a little bit harder to respond to all this and to keep things on the right track. But I'll say so far so good.
How would the bond repurchase program in the US being reduced, tapered, etc., affect your business in particular as we move towards maybe a higher interest rate, a normal environment?
I mean, we're all focused on where interest rates are going. We're most sensitive to the short-term interest rates, but it's also easier for us to make money if we have a steep yield curve. And relative to what the market was expecting when we last spoke, or when we spoke in a detailed way in February, the yield curve is quite a bit steeper, despite the fact that obviously longer-term rates have come back down. If the Fed begins to taper and we get an easing back up of 10-year rates or longer-term rates, which there's no sign of right now, I will say, right?
I mean, 1.17% for a 10-year yield is incredible.
There's no sign. But I think that also reflects a fundamental concern about the economic malaise, that maybe the very, very, very good times are petering out a little bit, which may be true. But we've seen it in China. China boomed in the early post-pandemic recovery days, and now it's normalizing. Well, that's normal, right? And that's fine. Normal is fine by us. I think it will help to avoid some of the bubbles that could come across anyway. And hopefully we'll get back to a little bit more normal yield curve over the next few years.
But taxpayers got to pay this bill back, haven't they? Ultimately, they've got to foot the bill as to what's happened fiscally speaking. So that, of course, dovetails into the IMF also talking about and downgrading growth forecasts in this part of the world. How do you make provisions for that, and how are you seeing it?
Yeah, governments do have to pay back the money that's been borrowed. But the cost of carrying that debt is very low, right? Because most of that was borrowed at close to zero interest rates, or at zero interest rate, or if you're in Europe, it's borrowed at negative interest rates. So the rush to pay that back is not too pressing. But we would expect to see a normalization of economic activity. So we've had a rolling boom on the back of stimulus and COVID recovery, and that's going to ease. The U.S. stimulus is going to ease up. The Chinese stimulus is already easing up, and that will normalize global growth.
Standard Chartered CEO Bill Winters there, speaking exclusively to Bloomberg's Rashad Salmat to just point out his mask. Because he was exempt from quarantine in Hong Kong, the rules dictated that he have to keep a mask on during the interview. Very interesting and kind of surreal to see. But later on, we'll get more into banking earnings. We're going to be speaking to Bloomberg Intelligence senior bank analyst Jonathan Tice about this morning's bank earnings. Of course, Standard Chartered there among one of them. Now on to China, where Chinese tech once again is in focus, this time with social media giant Tencent at the center. The stock cratering today, recovering a little bit, but after an offshoot of China's official news agency criticized video games, calling them spiritual opium. Joining us for more is Peter Elstrom, our executive editor for Asia Technology. Peter, I mean, pretty remarkable moves to see in Tencent after the Chinese big tech has already been under a lot of pressure. What exactly was it that the state media said that caused Tencent to just absolutely nosedive?
Yeah, it has been a tumultuous day here in Asia. As you pointed out, the state media publication came out and criticized gaming. It gave some anecdotes about kids who had been online playing games for hours at a time, 8 hours at a time, and it talked about the dangers of this spiritual opium, which certainly caught attention. So you saw Tencent shares fall very, very sharply at the open. Shortly thereafter, an interesting thing happened, though, and the website removed the link to this story that was criticizing gaming so forcefully. So Tencent shares bounced back up after that, and people thought, oh, there's this sigh of relief that maybe it's not going to be so bad afterwards. And then Tencent, on its official social media account, posted some steps that it may take in order to limit the amount of time that people actually play on games, taking these suggestions from the government about cutting back on gaming for kids very, very seriously. So there are a few things that they called out, including limits on how much kids can play games on weekends, on vacation times, particularly if the kids are under 12 years of age. So people are on edge because you've seen these rolling crackdowns come out of Beijing against financial technology, against education companies, and a bunch of others. So they're worried that gaming is going to be next.
Do we have an idea if there will actually be some regulation put on the industry? I mean, that kind of fold in the saga of removing the link for the story, does that indicate a sort of what direction that Chinese authorities might be leaning towards when it comes to this?
Well, it's a good question, and I think at this point, really, people do not know where this is going to end up. Gaming has come under criticism for years in China. It was about 4 years ago when state media called games poison, and there was a concern at that point that Tencent was going to get hit, along with some of the other gaming companies. One thing that Tencent appears to be doing here is signaling that they may take some proactive steps to be able to limit the amount of time that kids spend on gaming in particular. They're talking about requiring people to have their real names on accounts so you can keep track of these people, figure out what their ages are, and then perhaps impose some sort of limits. But regulators have not spoken about what they're planning on doing at this point, so the company may have some different ideas about where this is going.
Peter, you'll have to stay on top of that for us, where exactly those changes from Tencent come. That's our Peter Elstrom, our executive editor for Asia Technology. Thanks so much. Now, coming up, September taper. Federal Reserve Governor Christopher Waller weighs in on the debate. That's ahead of Friday's job report. We'll discuss it up next. This is Bloomberg.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature, it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
I assume you have a lot of people saying the food isn't as healthy as they might want it to be. Is that the biggest challenge, or just growing the company?
Ray Kroc had a famous line, if you're not green and growing, you're red and rotten.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to the Bloomberg First Word News. Here's Leanne Garens. Hi, Leanne.
Hey, Danny. The U.S. has reached President Biden's goal of 70% of adults being at least partially vaccinated against the coronavirus, about a month later than planned. Meanwhile, San Francisco and surrounding counties are reinstating mask requirements in indoor public spaces, regardless of your vaccination status. New York City has strongly recommended masks indoors, but without mandating it. Now, Germany is to widen COVID-19 vaccinations to include all 12 to 17-year-olds in an effort to reinvigorate the nation's flagging inoculation drive. The move goes beyond advice published by the government's independent vaccine commission, which recommends jabs for youngsters with pre-existing medical conditions. And New Zealand's central bank is further restricting access to mortgages as it attempts to cool a red-hot housing market. From October, the RBNZ is reducing the proportion of low deposit loans that banks can make. New Zealand has one of the world's hottest property markets, with prices surging 30% in the year till June. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. Now on to the Fed, where another Fed official has weighed in on the taper debate. Governor Christopher Waller says he could back an announcement by September on scaling back the central bank's bond purchases. That's if the next 2 monthly U.S. employment reports continue to show gains. Now, his comments also come ahead of Friday's non-farm data. Joining us now is Victor Yort, BNP Paribas Global Head of Credit Strategy and Desk Analyst. Peter, thanks so much for joining us this morning. Victor, rather, apologies. Thanks so much for joining us this morning. It's pretty remarkable to see that everything that happens, everybody seems to want to send yields lower here. 10-year nominal yields reaching their lowest point since February earlier yesterday. Does it make sense to you that this is the direction that we travel? Do we continue just to see those lower yields?
Well, I think it's an awkward situation for the Fed, given that they are just ahead of announcing a QE taper, and the way that whole yield move lower has played out, I think, is not at all what they would have expected. So at one level, inflation expectations are sticky, well above 2%, so they're sort of credible there. But the whole move lower in yields is driven by lower expectations of real yields, and that would be consistent with the market saying either you're facing stagflation ahead or that the Fed isn't going to tighten policy at all. So I think it is a awkward situation for the Fed. Can it continue? I think when this move started back in April, the consensus expectations of where rates were going was decidedly bearish. That seems to be shifting, but shifting fairly slowly, and will increasingly, I think, put a headwind towards how low we can go.
Right. And of course, you know, this creates some oddities in other markets. The real yield adjusting for inflation on triple B corporate debt now moving negative. I mean, what do you do with that area of the market? Is that something you want to own right now?
So with respect to corporate debt, I think we're actually supposed to be a bit cautious here. The underlying credit trends are fine. And the most important thing that's coming out of the earnings season at the moment is that corporates are still extremely risk-averse, holding close to record amounts of cash liquidity. And that means two things. One, it means obviously fundamental credit risks are extremely low. Corporates essentially default remote. And secondly, it also means that they really don't need to issue a lot of bonds, because they have the funding internally. So corporate bonds become sort of scarce. But what I think has changed since the early part of the summer is that the market is now positioning much longer than it was. So you're now in a much more crowded marketplace. That's true for both banks and asset managers, and introduces some vulnerability that really wasn't there before.
Interesting. So a crowded marketplace, does that mean that you want to kind of get out of the proverbial door, as it were, now for concern that we might see a stampede at some point?
Yes, avoid the crowds this summer. But seriously, it is one of these situations where when you have crowded positions, the frequency and the depth of corrections start to pick up, and that clearly allows investors to add, hopefully at better levels.
Yeah, avoid the crowds. Victor, solid advice both for maintaining healthy, avoiding COVID, and avoiding any damage in your credit holdings. Victor, thanks so much for joining us this morning. That was BNP Paribas Global Head of Credit Strategy and Desk Strategy, Victor Yort. Now, on to the banks. We're going to discuss Standard Chartered plans to pay a dividend as its profit jumps. SocGen says it will proceed with its buybacks, subject, of course, to what the ECB decides. Up next, we'll analyze the latest banking earnings with Jonathan Tice from Bloomberg Intelligence. This is Bloomberg.
a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising. We had a stellar first quarter. Things actually slowed down quite a bit in April, picked up in May, picked up some more in June. And I would say the level of business activity continues to remain pretty robust.
That was Bill Winters, Standard Charter CEO, speaking exclusively to Bloomberg this morning. Let's get more into the morning's bank earnings. We're joined now by Jonathan Tice, Senior Banks Analyst for Bloomberg Intelligence. Jonathan, first off, thanks so much for joining us. So we had Standard Charter this morning. You had a masked Bill Winters there talking to our Rashad Salamat, announcing a buyback. When you look through their earnings, what are some of the key takeaways for you?
I think that the issue we've got with Standard Chartered, and we've actually got a focus idea on it, is once again, we're being asked to wait until 2022 for growth. So there's no revenue growth this year. And they're still not doing enough on costs because every bank is now writing back provisions taken last year. A lot of banks have buybacks, a lot of them more meaningful than for Standard Chartered. And yet here they are again, currency's going against them, asking us to look through that and also saying, well, we may miss our target this year if we need to accrue for more variable comp. So I think had the stock not underperformed so heavily this year, it would actually be down today. So pretty disappointing results, really.
Jonathan, you're definitely striking a different tone than certainly Bill Winters, and even the market, those shares up 1%. Of course, another bank that reported this morning and was also pretty optimistic was SocGen. And earlier this morning, I did speak to its CFO, and he said this about its buyback program. Take a listen.
We have announced a share buyback in the second half of the year. So we will complete the share buyback. That's obviously pending a necessary administrative authorization by the ECB. That's for an amount of 470 million euros.
So, Jonathan, in that conversation, William, the CFO, also told me that it was the bank's best quarter ever. Considering you struck a little bit of a different tone with that of Standard Charter, do you think that that's an accurate description when it comes to SocGen, at least?
Well, it wouldn't have been the best quarter ever, but certainly for equities trading and for certain parts of the business it was. French retail's improved very nicely, but again, I point to the share price. I mean, SocGen is up nearly 60% this year. Standard Chartered's down 5%, and yet SocGen's up another 5% today. So they continue to deliver, and they're over-delivering on capital, whereas, as I say, for Standard Chartered, I think had it not underperformed so heavily year to date, it would be down today because they're just not doing enough on costs. Whereas if you look at SocGen, this quarter, their revenue grew 17% more than their cost base, which is a very, very good number. Look at Standard Chartered, that number was negative.
So, Jonathan, if I could get you to widen out a bit, we have a lot of European bank earnings under our belt now. When you look across the space, do we need to approach European banking any different than we did before the earnings? Have we learned anything material about where the banks currently stand?
Well, I think that there are some banks that have managed to deliver pretty good revenue this quarter. If I look at BNP, for example, fixed income and equities, they beat on. Deutsche did a good job on fixed income. But some of the banks are guiding to, well, costs may creep up because we have to make up for last year's lower variable comp. So costs are definitely going to be a debating point into the second half. Revenue growth, something we talked about for months and months and months, is back to the fore because there isn't very much of it, particularly net interest income growth. So I think those are two very key issues where we're beginning to see particular differentiation. And then you've got capital management as a way to drive earnings and shareholder returns. And that's where you look at a BBVA is going to buy back 10% of its shares. You've got UniCredit with a big buyback, NatWest, another big buyback announced. So we're definitely seeing from a capital management, sort of the lead management can pull, big differentiation between banks focusing on costs and capital management and those that are sort of sitting there hoping the environment bails them out.
Right. All right, Jonathan, thanks so much. That's our Jonathan Tice, Bloomberg Intelligence Senior Banks Analyst. Coming up, big oil boost returns. We'll discuss BP earnings next. This is Bloomberg.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Not playing games, Tencent slips the most in a decade after Chinese state media decries video games as spiritual opium. Bringing back the buybacks, Standard Chartered announces it will repurchase $250 million of shares and pay out a dividend as profits jump. And big oil's big beat. BP joins its peers in increasing buybacks and dividends as higher crude prices boost the bottom line. We'll hear from Bernard Looney. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. We're just heading up to 9:30 a.m. Now, looking at your market so far this morning, we are seeing a boost in both the benchmark index in Europe, the Stock 600, and American futures, both up between 2 and 0.3%, despite a wobbly session in Asia. Certainly got nerves going after fears of more regulatory crackdowns, but it's all about earnings season as we continue to look at the beats. We're looking at a U.S. 10-year yield higher by about a basis point after yesterday. Your nominal 10-year yields hitting the lowest since February, an all-time new low on your real yield. A real move into bonds, and the Aussie dollar moving higher today. There were some thoughts that perhaps the RBA would be more dovish in their decision. Instead, they're going ahead with the tapering. What does that portend for other central banks? But let's get to a key earnings story today. And BP is following its big oil peers in increasing dividends and share buybacks. That's, of course, as higher crude prices have boosted profits. BP CEO Bernard Looney spoke to Bloomberg's Anna Edwards just a little bit earlier.
I think our team has done a great job in the past quarter, and we have taken the decisions that you've just talked about, and they're really based on three things. Number one, Anna, it's the underlying performance of the business, which, if I can say, has been strong in the quarter. We delivered our cash cost savings target 6 months ahead of plan. We actually had the strongest convenience result in this quarter in our history. So the underlying business, first and foremost, is performing very well. Secondly, Anna, the balance sheet continues to strengthen. This is the fifth quarter in a row where net debt has come down now to $32.7 billion. And thirdly, it's about our confidence in the outlook for the environment. So when you look at it from that dimensions, they're the reasons that we've taken the decision that we've taken. $1.4 billion worth of buybacks in the third quarter and a 4% rise to the dividend. And actually, as we look out, Anna, over the next 5 years, at an oil price of around $60, we have the capacity to raise that dividend annually by about 4%, as well as, by the way, $1 billion a quarter approximately of buybacks. And that's about $4 billion a year at $60, which is probably 5% of the market cap of the company today. So that's really what this is about.
Okay, and you've increased the dividend and you're doing this share buyback. I think you've said in the past that any excess cash would go in share buybacks and not in an increase in the dividend. So is this a change of position on the dividend? Why that change in thinking?
So our financial framework, Anna, remains exactly the same. There are 5 elements to it, and the first priority in our financial framework is a resilient dividend, and that absolutely remains the case today. And priority number 5 is that we'll distribute excess cash, 60% of excess cash, to our shareholders in terms of buyback. What you're seeing around the dividend is really a story of confidence. It is a story of confidence in the underlying performance of the business. It's the confidence in the balance sheet. And 12 months on from when we laid out our strategy, of course, the world's in a very different place with the environment. Global GDP is now back to pre-pandemic levels. The vaccines clearly are working. People are back flying, not to the same extent, but they're back flying. People are back driving. Not alone that, but we're also seeing OPEC Plus has maintained strong discipline. And then, Anna, in the US shale business, which has typically been a huge responder to prices, you're seeing a different business model emerge there, where cost of capital is higher and investors and operators are being much more disciplined and focusing on cash. So it is a very different world, and that's why we've gone ahead and made the decision that we've made around the dividend.
BP CEO Bernard Looney speaking to Bloomberg earlier this morning. Let's dig in to earnings and how the markets are shaping up amid all of these reports. Joining us now is Bloomberg MLive editor Eddie van der Walt. Eddie, okay, so another really busy day for earnings. We just heard from the BP CEO there saying, okay, we're giving out dividends because we're just so confident in our results. Should the market be confident in big oil's results as well?
You know, I think that's the story across the board from these earnings. The question is whether these companies will be able to sustain it. I think the problem for a company like BP is that its problems hasn't gone away. A lot of the upside that they've seen here is a result of OPEC and of the cuts in production. Now, yes, oil demand is bouncing back, but at the same time, there's a lot of people are finding that they love electric vehicles. A lot of governments are saying, look, ESG and we see the pandemic as an opportunity to pivot towards green economies. And I think that hasn't gone away for these companies. We asked Markets Live readers at the beginning of the year where they see oil prices at the end of the year. They were talking about $45. Now we're sitting at $70. I think a lot of that has to do with OPEC. And OPEC is starting to show signs of cracking. OPEC is starting to show signs of wanting to pump more oil.
Right.
So whether these prices are going to be sustainable, we shall see.
And is that kind of the story for just the commodity space in general? Obviously, OPEC is a very, idiosyncratic driver. But just in terms of, okay, do we have this commodity super cycle? Is that just over now? Is that no longer in the picture?
So the commodity super cycle is a really interesting one. And I think, you're right. The BCom is down over the last 3 days. And we're definitely seeing some softness there. And the reason we're seeing some softness there is because China is suffering a little bit, right? Chinese consumers are not as strong as we assumed that they would be. And in the West, we are pivoting away from goods to services. I had my first holiday, in about 2 years, just last week. And, a lot of people are doing that. They're not spending money on iPhones and on goods anymore. They are spending money on going out.
Yeah, Eddie, you need more holidays. That's
we all do, don't we? But I think China therefore suffers a little bit, and that is weakness for commodities in general. So I think we are seeing commodities come back a little bit, which takes pressure off inflation.
But it used to be that the Chinese economy and the picture in China would tell us something about the global economy, that the way they go is going to affect all of us. Is that still the case right now?
I think you've absolutely nailed it on the head. That's the big topic for me. I think that we might see a little bit of a decoupling here. And I think central bankers in the West will love it, because I think if we spend more on services, that means more employment in the West. At the same time, less inflation, because we're not putting so much pressure on the supply chains, right? And if we don't see that much pressure on inflation, they can keep rates lower for longer, and equity markets can keep on rallying.
I see. Well, it certainly is going to make a lot of difference coming up as we continue to see pressure emanating from China. Eddie, thank you so much for joining us today. Always a pleasure to have you on. That's our Bloomberg MLive editor, Eddie van der Walt, who hopefully we'll be going on a holiday again soon and won't wait as long this time. Now, coming up, we're going to continue the earnings conversation. Generali is set to start the process of board renewal in 2022. We'll talk to the CEO, Philippe Donnet, about his outlook for the Italian insurer. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Some of the best deals in history have been passed on by a very large number of people. The money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
The Delta variant is on the rise, infections are increasing, but at the same time, vaccinations are also increasing. So I remain very prudent when it comes to predicting economic activity going forward, because we have to see how the Delta variant is impacting us, while at the same time, vaccination is increasing.
That was AXA CEO Thomas Buberl speaking to both me and Manus Cranny earlier this week. Now, the French insurer saw a rebound from the COVID hit, with its profit more than doubling. First half earnings results across the insurance industry do show signs that the sector is recovering from the pandemic. Italy's biggest insurer, Generali, reported first half net income of 1.5 billion euros, up from 774 million euros a year earlier. Generali confirmed performance is on track to deliver this year's targets, as COVID-related impairments on investments were not repeated. Let's get more into this. We're joined now by the CEO of Generali, Philippe Donnet. Philippe, first off, thanks so much for joining us today. Really strong set of numbers out. First half net income beating analyst expectation. Outlook is strong as well. So going forward, where are you seeing the biggest opportunities for growth?
I think there are great opportunities because of COVID. Many people during this terrible crisis have understood that they are not protected enough. I'm talking about families, I'm talking about small businesses, small companies, SMEs. And this is a great opportunity for us. As you know, we are very much focused on families, on SMEs, and we are providing more and more personalized solutions to protect better our customers. And in Europe, and as you know, we are the leading insurance group in Europe. Europe is full of growth of opportunities for better protecting people against risks of life, against health problems. So many opportunities for Generali in the future.
Right. Well, when it comes to those opportunities, let's talk about M&A, because, of course, that features in this earnings presentation as an important key to reaching your 2021 plan. What type of deals are you targeting? What specifically are you looking at?
We are looking at opportunities that allow us to accelerate the implementation of our strategy, which basically is to further diversify our portfolio of business. So we are focused on P&C business, on protection business, on unit-linked business, on asset management business. On a geographical standpoint, we are willing to further strengthen our market position, especially in European countries. Basically, we want to continue doing what we have done in the past few years when we acquired some company in Greece to become the number 2 player on the P&C business in Greece, when we acquired a company in Portugal to become the second player in Portugal. This is exact. And when we acquired a company in Malaysia to become the second player on the P&C and health business in Malaysia. So we like this medium acquisition with low execution risk, which allow us to extract synergy and create value for our shareholders.
Okay, so more medium-type acquisitions. I want to stick in Europe and talk about something that's featured heavily for a lot of insurers, and that's been some of the natural disaster and the claims from that. And the earnings, you cited 218 million euros coming from the storms, be it in Spain in January or June, some of the storms in Europe. But of course, in July, we've also seen some impact to Germany. What level of claims are you expecting to come forth from that?
Well, definitely what happened in Germany is very important. It's also very sad because, as you know, many people lost their life. Families have been impacted. We are a very important player in Germany. We are the second player in Germany. So definitely there will be an impact. But as you know, we are very well protected with our reinsurance treaties, and our net impact could not exceed 100 million on this event as well.
Okay, and in terms of just the spread of the variant and Delta, how does that impact your outlook?
It's difficult to predict what's going to happen. We strongly believe in the vaccination. By the way, in Milan, we have created the biggest vaccination hub in the region. It's really important. This is, according to us, the only way to fight any kind of variant. The vaccination is progressing quite well in Europe, so we feel quite confident that we will be able to manage the next wave, because the next wave is coming, and that will be able to protect the economic recovery. So we are quite confident.
Right, and that's definitely something everyone is looking for, some protection and concerns about another wave. Philippe, your term as CEO expires next year. Will you be running for a new term?
Well, the whole board of directors expires next year. And as you know, we decided during the board of directors yesterday to start the preparatory work to prepare the procedure that will be submitted to the next board of directors. So the procedure to make the new list for the next board of directors. So this is my personal situation is part of this, and it's a bit early to talk about that.
All right, a very diplomatic answer, Philippe. Definitely appreciate it. That's Philippe Tonnet, CEO of Generali. Thanks again for joining us this morning. Now let's get to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. Societe Generale has given an upbeat outlook for the year as it set aside less money for soured loans and reports a rebound in equities trading. Paris-based SocGen predicts business will increase in all units after revenue and net income for the bank as a whole blew past estimates in the second quarter. Now, BMW has joined other car makers in reporting strong earnings dampened by warnings about the global chip shortage. Earnings before interest and tax surged to 5 billion euros in the second quarter, while ahead of estimates for 4 billion euros. Meanwhile, Stellantis, formed from the merger of Fiat Chrysler and PSA Group, raised its full-year profitability forecast, and that was substantially. Strong demand and pricing saw the company beat estimates in its first earnings report. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks so much. Now, up next, we're going to talk about life after LIBOR. A Fed-backed body endorses a new benchmark, a milestone in the transition away from LIBOR in the U.S. We'll get into all the wonky wonderfulness for you. That's next. This is Bloomberg.
if inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
We had an exceptional Q2.
It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, the transition away from LIBOR has reached a key milestone in the U.S. Officials at the Federal Reserve-backed Alternative Reference Rate Committee, or ARRC, have officially endorsed a series of forward-looking benchmarks that are tied to SOFR. Now, specifically, they have backed the CME's term rates for 1, 3, and 6-month tenors. It comes following the key completion of a key change in dealer trading conventions as part of the SOFR First initiative. The announcement is expected to pave the way for SOFR's usage more broadly in markets. Joining us now to discuss is our money markets reporter, Alex Harris. And Alex, this, of course, is hugely important. Hundreds of trillions of dollars in financial products and loans tied to LIBOR and need to look for a change, a different way to operate. So the ARRC endorsing this forward-looking term rate structure for SOFR. Why exactly is this such a big deal in terms of getting a replacement for LIBOR?
Thanks, Danny. So the big issue with this has been, the cash market. The cash market has not wanted to transition. They said we're holding out for this forward-looking term rate because they were looking for something that was simple to replace LIBOR, and it just wasn't there yet. The way the transition was kind of done, if you look at sort of how markets have developed, you've always kind of had the cash market come first, and then you've seen the derivatives. This was sort of done in a backwards way, where the derivatives market for SOFR was created first, and you needed to see that pick up in order to get that term rate based on the way that they were structuring these things. But the cash market was saying, these conventions aren't working for us. We need just a forward-looking term rate, something that looks like LIBOR but isn't LIBOR, that's tied to the secured overnight financing rate, which is essentially underlied by a trillion-dollar repo market.
There's still been a lot of holdouts in terms of actually using SOFR. So you have, for example, users of syndicated corporate loans, collateralized loan obligations, really holding out. Does the introduction of these terms, does that help to address the issues that are holding them back from adopting SOFR?
I think that's I think that's the idea is, again, like I had said, they wanted something that looks like LIBOR, but isn't necessarily LIBOR. And so that's what I think they're hoping to get out of this. The other side of this, though, is the banks. And this is where that credit sensitive component comes in, is that they're still taking on a lot of that credit risk. And so they're considering, whether or not this is suitable for them as well. So it's going to be sort of a two-way street in figuring out what's best here. But I do think that there is that opportunity for pickup.
So, Alex, if we're trying to kind of figure out, okay, is this endorsement working? Are more people adopting SOFR? For a more casual observer for this, what are sort of the expert data points that you look at to assess how the adoption is going? What should we be watching out for here?
Well, I think, first of all, you are going to be looking for issuance. Are we starting to hear about more companies issuing loans, CLOs, those kinds of cash products tied to term SOFR? So that's first and foremost. I think secondly, from like a more nuanced market perspective, we're looking at bid-ask spreads in SOFR swaps, because that's what SOFR First Initiative ultimately did in forcing the dealers to move to these trading conventions. It's supposed to narrow those spreads. And so if it makes it cheaper to transact in SOFR for your clients, they might be more inclined to do SOFR swaps and other kinds of hedges in SOFR as opposed to LIBOR, because it is just going to be a bit cheaper for them now.
Alex, thanks so much for joining us. Of course, this is a very complicated topic. Really important to have you walking us through it, and of course, waking up early to do it as well. Thanks again to our money markets reporter, Alex Harris. And just to let everyone know, the Bloomberg Short-Term Bank Yield Index, also known as BSBY, an alternative to dollar LIBOR, is administered by a subsidiary of Bloomberg LP, the parent company for Bloomberg News. Now, a quick check on your markets as we close out the hour. We're looking at markets higher, both in terms of U.S. futures and your cash trading in Europe. We're looking at not much movement on your 10-year yield at 118. We'll continue to discuss these market moves in the next hour. Bloomberg Surveillance Early Edition continues on. Matt Miller and Kaylee Lyons will be joining me both out of New York. This is Bloomberg.
This year, E3 is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
The video game industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
If you're not Apple, and you should be way down the road in terms of contingency planning, just so you don't have over-reliance on China.
Investing heavily in China and the rest of the region. We're very confident about the long-term macro growth trends in Hong Kong, mainland China, and the rest of Asia.
Geopolitical tensions are always on our mind, but the fact is the Chinese economy is going gangbusters. The Chinese connection to the rest of the world is increasing, not decreasing.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, August 3rd. Our top stories today: Tencent tumbles. China media blast raises concerns that Beijing's next crackdown will be aimed at online entertainment. SocGen's sunny outlook. The French bank gives an upbeat forecast for the year after beating estimates. And why the virus may affect the vote. A Republican senator tests positive for coronavirus, possibly throwing a roadblock in the way of the infrastructure package. I'm Danny Berger in London alongside Matt Miller and Kaylee Lines in New York. Francine Lacqua is off this week. And look, equity markets might be moving higher in Europe and the U.S. today, but Kaylee, the handoff from Asia seems to be less about animal spirits and more about spiritual opium, it would seem.
Yeah, Danny, that's exactly right. The risk-off tone was definitely evident once again in the Asian session. Concerns around a regulatory crackdown from Beijing once again rearing its head. We did see the CSI 300 manage to close essentially flat on the day, but the Hang Seng was lower by a few tenths of a percent, and the Hang Seng Tech Index actually fell 1.5%. And the big drag within that was Tencent. This after China's official news agency was out with an article that has actually since been deleted, at least online, calling gaming the spiritual opium and really criticizing it. And of course, that raises concerns that online entertainment could be the next target of Beijing in terms of this clampdown. And Tencent now says it may not even sell games to people under 12 anymore. That took the stock down 6%. That was off session lows, though, by the close. And in foreign exchange, my focus is elsewhere in the Asia Pacific. Your big outperformers include the Kiwi and the Aussie dollar. The Kiwi stronger against the U.S. dollar by about 0.5% on bets of policy tightening. And the Aussie dollar stronger by about 0.4% as the RBA says it's sticking to its taper plan, even despite the current virus outbreak in Australia. As for the picture here in the U.S., of course, we did see that softer ISM manufacturing print yesterday that saw stocks close around session lows and yields moving dramatically lower. This morning, though, we are up about 0.3% on S&P 500 futures, and we are ticking just slightly higher on the 10-year Treasury yield, right now at 1.18%, just off of the lowest level since February. The dollar is weaker for a 6th day in 7, and that may be part of what is helping oil recover. WTI fell 3.6% yesterday. This morning, though, futures up about 1%. Trading at $71.91 a barrel, Matt.
I'm not sure spiritual opium is really that bad. I think some people maybe need a little bit of spiritual opium in their lives once in a while, but just not too much. That's the problem. You don't want to get addicted. And with video games, I guess that's kind of what they're pointing out. Take a look at what's going on in European markets. Actually, we had much bigger gains at the beginning of the session. So in the last hour, we've seen these numbers come down a little bit. You can see now we're little changed in Germany. Now we're little changed in Spain. We had much bigger gains there. We still have a strong session in France with the CAC 40 up 0.8%. Louis Vuitton Moet Hennessy doing extremely well there. In fact, take a look at a lot of the stock stories. We have so many corporate earnings out in Europe that I just picked a whole bunch of stocks here to focus in on. Oil is helping BP, but also earnings positive at BP, and they're going to be giving more money back to shareholders. This is the story with the oil producers, up 3.5% right now. It's a huge weight on the FTSE. It's a huge weight on the Stock 600 as well, so helping to lift those indexes. SocGen also is a story that we're going to talk about doing better, forecasting a better future for the equities business, and also reducing those loan loss reserves, helping SocGen, as it has with other banks, European banks that have reported. And then a couple of car makers. Stellantis is, of course, Fiat Chrysler after its merger with PSA. I'm still not 100% sure why they're called Stellantis. In any case, they're doing very well today as they forecast margins of 10%. EBIT margins of 10%. That's like the holy grail for automakers. That's like what Ford does with the F-150. You want that kind of margin as your goal, and they're hitting it. BMW has forecast margins of 7 to 9%. Not bad for a German car maker, not bad for a European car maker. The problem here is they're saying the chip problems may last longer, and that's really overshadowed the big earnings beat. I will point out they had earnings of 5 billion euros in the quarter, and analysts were only looking for 4 billion, so 25% better than the street's estimate, and nonetheless, the chip problem is taking them down 4% on the DAX this morning, Danny.
Yeah, Matt, Morgan Stanley out with a note about BMW asking the question, what is sustainable? I mean, you just look at the share price you have there compared to Stellantis. There seems to be some disbelief that they can hit margins like you described with what Stellantis is pulling through.
Yeah, absolutely. And BMW hasn't pulled out all the stops in terms of shifting to an electric car maker. That seems to be a lot of what the market wants to see. We've heard tens of billions in spending plans from Volkswagen, tens of billions in spending plans from Daimler. Stellantis is, I think, spending $30 or $39 billion on, turning itself into an electric car maker. Whether or not that's 100% what's really happening, it seems to be a story that investors want to buy into.
Yeah, and BMW even citing higher motorcycle sales. I can't believe Matt Miller purchasing motorcycles didn't carry BMW.
I bought one this year. I bought one this year.
Very strange. All right, well, let's get a look at what's ahead for today. At 10 a.m. New York time, we're going to get U.S. durable goods and factory orders. We also have SEC Chairman Gary Gensler giving a speech on crypto regulation today at the virtual Aspen Security Forum. Check out today's big read by Bloomberg covering all of this and Gary Gensler's views on crypto. And finally, we'll also be getting earnings results from Alibaba and Lyft. Let's turn to China, though, where China has taken another shot at another industry. This time, it's online gaming. Tencent plunging after an offshoot of China's official news agency criticized video games. Let's get more on this with Bloomberg's Zeping Hong from Hong Kong. So, Zeping, the state media putting this out, but then shortly after removing the link online for this article that called gaming spiritual opium. What do we make of those moves?
Right, so the article we saw in the morning is from a newspaper owned by Xinhua, which is China's top news agency. But it's worth noting that it's not an official Xinhua editorial, but it's an investigative piece done by state reporters. That the story was removed later around noon today is probably a sign the reporters went too far, triggering a market sell-off they didn't expect. But the report itself still carries weight as we see from what investors reacted. Like in the past China tech crackdown, investors first sold their stocks before they asked questions. And also later in the afternoon, we saw Tencent came up with a pledge where it says it will further cut time play for its minor users.
Of course, another Chinese tech company that has been a victim of the regulatory crackdown is Alibaba, and we will be getting those earnings later on this morning here in the U.S. What kind of bellwether could it be?
Right, I guess in Alibaba's case, it already paid a record 2.8 billion antitrust fine, so it's trying to move on. So investors will focus on its core China commerce business, but it's worth noting that the second quarter is relatively uneventful because overall China's online sales isn't doing that great. And then it's also worth paying special attention to Alibaba's cloud computing revenue. Last quarter, we saw the segment grew the slowest since 2014 after a key client, which source told us is ByteDance, withdrew their contract with Alibaba. So how will the cloud do this quarter, in the past quarter, will be a key area to pay attention to.
We'll watch closely, Zheping. Thanks very much for for the insight. Bloomberg Jiping Wang there talking to us about the spiritual opium, Tencent and Alibaba that's to come. Now, European bank earnings continue. Stanchart overcame economic headwinds across Asia, and Soc Gen gave an upbeat outlook. We spoke to top executives from both banks on Bloomberg.
We had a stellar first quarter. Things actually slowed down quite a bit in April, picked up in May, picked up some more in June. And I would say the level of business activity continues to remain pretty robust.
We have announced a share buyback in the second half of the year. So we will complete the share buyback. That's obviously pending a necessary administrative authorization by the ECB. That's for an amount of 470 million euros. And in the years to come, the payout on which we provision for our distribution, i.e. 50% of underlying results, includes a portion of share buybacks.
Bloomberg finance reporter Tom Metcalf joins us now to talk about really this trend, Tom. We've seen people just reducing loan loss reserves, and that's helping, but also give an upbeat outlook, some of these banks, Soc Gen, for example, in terms of equities.
Yeah, absolutely. It's kind of the message coming from all the European banks this earnings season. You're like, hey, we're blowing past estimates, but as you point out, that's in part because of loan loss releases. But also saying, hey, this is not as bad as we feared, and things are looking up for this year and next.
And what about buybacks and dividends? Should we expect to continue to see these kind of increases, Tom?
Yeah, so Winters on Bloomberg TV earlier did sort of suggest that maybe even this year there might be another buyback. So they're just constantly looking at their capital levels and seeing how they can best use it. So he indicated, hey, we might do some M&A, but equally, if we can't find a good M&A opportunity, expect buyback.
Tom, thanks so much. That's Bloomberg's Tom Metcalf. Now, from banks to D.C., where Lindsey Graham, a key Senate Republican, has tested positive for coronavirus, and that could delay Democratic plans to pass that infrastructure bill this week. Bloomberg Washington correspondent Anne-Marie Horton joins us from our D.C. bureau. So the timeline is upset, Anne-Marie, but does this change the likelihood that we actually get this infrastructure bill passed?
Well, whether or not we do have a vote from Senator Lindsey Graham, depending on whether or not he will be in quarantine, is unseen at the moment. And the legislation could pass without his vote. But he was a critical member of that bipartisan 10 group of senators to come up with this. And he was also key to getting other Republicans on board to vote for it. And he's a key voice for this legislation. And unlike the House, the Senate does not have proxy voting. So his vote would not be there if he was still in quarantine. So that's one thing we should keep an eye on. The second is that he was in attendance of a gathering over the weekend with a number of other senators on Senator Joe Manchin's House vote from West Virginia. Now, all those senators who said they were in attendance are following CDC guidelines and have tested negative. But, Danny, it just brings this cloud of worry over Congress about potentially more positive cases and these breakthrough cases when it comes to coronavirus. So this could potentially be a wild card when you have Senator Chuck Schumer saying he wants it done by the end of the week.
Anne-Marie, there also is still a focus on the eviction ban. The Biden administration asking the CDC to extend the moratorium in a targeted way. Will that happen?
It's very difficult to see how this can happen, given what we heard from the Supreme Court at the end of June. The Supreme Court saying that it has to come from Congress. And even in that memo following that decision, Justice Brett Kavanaugh said that this would give states and local authorities enough weeks to potentially tap some of that $47 billion of rental assistance. And just a fraction of that has been used, about $3 billion. So legally it'll be difficult for the White House, and they are on the phones trying to get this through. They're come under a ton of pressure from their own party, the progressive left. You even have some representatives sleeping on the steps of the Capitol to draw attention to the fact that millions could be evicted from their homes. That is one thing they're trying to do legally, but it does seem that's going to be a lot of hurdles. So they are really pushing for state and local authorities to tap that money that is there waiting to be used.
Although at the last minute, right? They could have started a little bit earlier.
Well, here's the thing, Matt, and it's a very good point. A lot of members of Congress were saying how do you tell us on Thursday that this is going to end on Saturday and give us 2 days to try to whip up votes to get this through? The problem is, though, at the end of the day, we all knew this was coming. The Supreme Court decision came at the end of June, and it was made very clear that it would have to go through Congress.
All right, Anne-Marie Hordern, Bloomberg Washington correspondent, thank you so much. I do want to take a quick check now on some stocks moving in pre-market trading here in the U.S. And a big one to the upside is T-Bio, which of course is up 29%. Sanofi buying the company for $3.2 billion, trying to push more into messenger RNA, paying a 30% premium to yesterday's closing price for it. Another stock moving to the upside is ZoomInfo, a marketing software company. It was out with a beat and raise quarter after the bell last night, up 13% in early hours as a result. And finally, one more stock moving to the upside is DigitalOcean. Citron Research was out with a report yesterday saying the company is like the Shopify of cloud computing, slapping a $200 price target on that stock. This morning, it is trading at just $59.80, though it is higher by about 5.5% before the bell, Danny.
Wow, that's quite the upside price target. Will anyone be able to challenge AWS? Always interesting to see research that suggests so. We'll get into the more market conversation more coming up next. We have Julian Chillingworth, Rathbones Chief Investment Officer. Later, we're going to be speaking to Grace Peters, JP Morgan Private Bank EMEA Head of Investment Strategy. More conversations to come. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I don't think that the market is concerned about Delta as much as they're concerned about what Delta will do in terms of how it impacts inflation. And I know that seems odd, but the more we have Delta spread globally, the longer the supply chain disruptions will continue.
And that was Shanna Cecil, CIO at Spotlight Asset Group, speaking earlier on Bloomberg. Joining us now is Julian Chillingworth, Chief Investment Officer at Rathbones. And Julian, we were talking to Shanna about low rates. Why are we still seeing less than 120 on, the 10-year or negative 120 on in real rates? And no one's really come up with a great answer to the question, but it definitely points to something that's amiss. How do you see it?
Well, I think the way we see it is that the message coming out of the Fed is pretty clear that they are not really moving to tighten monetary policy or rates in the near term. It's a message from Jay Powell, despite some of the comments from his fellow Fed governors. And that's because the labour market is not back to a level that they had been viewed as being satisfactory for them. And I think we've got the upcoming non-farm payroll numbers coming in Friday. And I think they're going to be looking closely at those.
So with yields where they are, how does that make you want to rethink your equity strategy, Julian?
Well, I mean, we continue to favour equities and we'll continue to do so in the current environment. And we believe that we're going to continue to see decent pickup in company profits, inventory rebuild, and particularly probably a switch from consumers moving more towards services from goods. And that will be good for certain areas, hospitality, etc. And I will point out that if inflation does remain high, than expected, then certain areas of the equity market will remain more resilient, like financials and energy names.
I mean, it is remarkable, Julian, in these earnings, we keep hearing about companies warning about higher prices, and some of them warning about, okay, we're going to see this out into 2022. As the market starts to shift from concentrating on this earnings season to next year, what do your inputs look like right now when it comes to the cost pressure that corporations are going to face?
Yeah, I mean, I think that they are going to face some cost pressures. I think the labour issue will begin to unwind. The real pressure for labour is more in the US than it is in Europe. And I think that as the COVID-19 payments unwind, and they're already doing that at state level, you will see more people returning to the workplace, and that will ease some of the labour pressure. And I think that some of the supply chain bottlenecks are going to begin to slowly unwind, with particularly around transportation and to the back end of the year around electronic components, particularly chips. So I think there will be pressures, but I think they will be manageable. Yeah. And I therefore think we're continuing to see decent earnings numbers come through.
My question is, does demand fade from here, Julian? I mean, have we all kind of gotten it out of our system in terms of what we need to be spending our pent-up savings on? Is that ship sailed now?
Yeah, well, I think goods is probably basing out, but services is where I think you'll see a big pickup. So more people eating out. And it's very interesting. I saw some data out of a Florida activity survey recently where a pickup in restaurant bookings is continuing despite a rise in the Delta variant, and also footfall in shopping malls remaining high. So I think people will get out there and they will be looking to get more into the buying services than necessarily buying more things.
All right, we have to leave it there, but thank you so much for your insight today. That's Julian Schillingworth, Chief Investment Officer at Rathbones. This is Bloomberg.
What you said was we need to make them in America. Does that include overseas companies making them if they have the plant in America?
I would certainly be in favor of them having operations in America, absolutely. You know, Samsung, TSMC, there are companies that are in allied countries, and you know, we certainly want them operating in America and producing chips in this country, yes.
So we have a significant chip issue, but there are other supply chain issues as well. As I know you're monitoring what's going on. Where have you seen other problems in the supply chains right now in the United States that need to be addressed?
Particularly in home building supplies, you know, lumber and all the related supplies, glue, adhesives. And you see it playing out. You know, home prices are high. If you go to Home Depot or Lowe's, you'll see prices are a little bit high. So, and that's all because of the lack of supply, just disruption.
assume you have a lot of people saying the food isn't as healthy as they might want it to be. Is that the biggest challenge, or just growing the company?
Ray Kroc had a famous line, if you're not green and growing, you're red and rotten.
People here on Earth who are wondering, why are we investing all this money in space, this time in space? Talk to us about how you believe this will actually help benefit us here on Earth.
We're building infrastructure. This is a road. We're building a road to space so that future generations can build the future. We live on this beautiful planet. It's the most beautiful planet in the solar system by far.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Danny Berger in London. Francine Lacqua is off this week. Now let's get the first word news. And the surge in COVID cases is increasing pressure on U.S. drug regulators to fully approve the Pfizer vaccine. It's the only one that was the first to apply for full licensure in the country. Approval could help the Biden administration ramp back up its immunization drive and reassure vaccine holdouts that the shots are safe. It's the biggest resource injection in the history of the International Monetary Fund. Member nations have approved $650 billion to help countries deal with mounting debt and the fallout from the coronavirus pandemic. IMF Managing Director Kristalina Georgieva calls it a shot in the arm that will help boost economic stability. And a labor union may get the chance to reverse its loss to Amazon. Bloomberg's learned that a federal official has recommended overturning the results of a union election at an Amazon warehouse in Alabama. The National Labor Relations Board hearing officer says the election should be run again. Amazon can appeal that decision. The union accused the company of making anti-union threats. And coming up next, we'll get back to the markets and European earnings season with Grace Peters, JP Morgan Private Bank EMEA Head of Investment Strategy. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London, alongside Matt Miller and Kaylee Lyons, both in New York. Francine Lacroix is off this week. Now, Matt, here in the UK, we are dealing with something very specific related to COVID called the ping-demic. That is, you get a ping on your phone when you have an alert that you've been close to someone who is tested positive for COVID. The government yesterday announcing they would reduce the sensitivity. I mean, I think there's a saying about a horse and a gate. It might be a little bit too late. There are already so many people in isolation because they've got a ping on their phone.
Yeah, I mean, there are, but maybe there won't be in the future. And I think the point is, you know, if you're vaccinated, you're less likely to get it. It's starting to seem like it's still very, very possible that you do, but you're very unlikely still to get seriously ill. And I've looked through the CDC numbers. I've talked to a number of epidemiologists and doctors about this over the last few days, and maybe it just doesn't matter as much. I mean, a lot of people, doctors have been telling us, if you're vaccinated, don't even bother getting tested because you're just going to be fine. Now, the problem is then you're going to be spreading it to a lot of other people, possibly those who are unvaccinated, and that's where the real problems come in.
I mean, I think this is an interesting thing, Matt, because you might say, okay, you're vaccinated. It doesn't matter if you get it. You won't be hospitalized. But Kaylee, it feels the market still cares. The market is still concerned about growth concerns when it comes to the spread of the Delta variant.
The question is, Danny, does it change consumer behavior? Because even if the science says that if you're vaccinated, you won't get that sick, people still may be less willing to go out into this economy and spend, to go back to the office, to do those things. So that is really where the growth concerns come from. They don't seem that evident, though, at least this morning, because you are seeing stocks higher in the European session. The stock 600 up by about 0.25%. And here in the U.S., futures are pointing to a firmer open in about 4 hours' time. We're up about 0.3 on S&P E-minis. Of course, we did see yields moving pretty dramatically lower, down 4 or 5 basis points yesterday off of softer ISM manufacturing data. But of course, we are lifting just a touch, 1 or 2 basis points on the 10-year Treasury yield, but still at 1.19%. We are south of 120 and right around the lowest levels since February. I would also point out that oil is rebounding after a 3.6% drop in WTI futures yesterday. We're up about 0.7% right now to 71.77 a barrel. Of course, it also still is earnings season, and we have a number of earnings movers, related earnings movers in pre-market trading. Of course, Stellantis, the automaker, raised its profitability outlook today. It really is benefiting from the fact that car prices are so high. That's helping out margins. It's up 5.4% in early hours. Zoom Info is higher by 14% after a beat and raise quarter, but the story is less good for Take-Two, the video game maker. Its revenue guidance missed expectations. That stock down 4% as a result. And of course, we will be getting earnings from Alibaba coming up at 7 a.m. Eastern Time, a really big bellwether for Chinese companies. That stock just slightly lower ahead of that, Matt, down about 0.9%.
You know, I'm also Stellantis, which owns Jeep and Ram. I think they make the biggest inches. I mean, the largest displacement V8s at 6.4 liters. Short of course, Rolls-Royce or Lamborghini or Bugatti. In terms of a regular truck that you can buy, that's the biggest displacement. And I've always thought there's no replacement for displacement. But I digress. I do want to talk about oil, and I've got a chart. I'll welcome our listeners on London DAB Digital Radio and just tell you what this chart shows. In white, we've got the oil price. And yes, it's been really volatile the last couple of days. But since the bottom of the pandemic, it has just gone up, 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 up to between $70 and $80, depending on whether you're looking at NYMEX or Brent. There's a blue line here that shows the stock 600 oil and gas producers. And, you know, the gap at the beginning of the year, people were saying, you got to play this gap because the oil and gas producers haven't done anything near as well as the actual underlying commodity has done. Well, that gap has just widened. Now oil is up something like 41% year to date, and the producers are only up 5%. I wonder why. Why aren't producers doing quite as well as the commodity that they pull out of the ground? Joining us is Grace Peters, EMEA head of investment strategy at JP Morgan Private Bank. Grace, is this all about ESG? Are investors just shunning the BPs and the Royal Dutch Shells of the world because, they're not doing nice things for climate change?
Morning, Matt. Good to be on the show. So I think firstly, just to start with the oil price itself, we think we're now in the range of what is going to be a fair value for oil, $70, $75, when we look out over the next 12 months. As you say, when it then comes to oil equities, we have seen the complex lag quite considerably since the start of the year. And broadly, I think categorizing that as due to ESG concerns is right. But more specifically, why be concerned? We know that oil majors have got quite a heavy capex burden ahead of them as they transition their business models towards, alternative sources of energy. And I think investors are concerned about how managements balance that capex burden with achieving a rate of return on the spend, but also with requirements around still debt pay down, reducing leverage, and of course share buybacks and dividends. So I think what we've heard from corporate earnings season, this morning out of the sector and broadly so far is reassuring when it comes to being able to achieve that balance.
Well, and we've seen beats really across Europe. I mean, BP was out with second quarter adjusted net that beat the street's estimates. I was just talking with Kaylee about BMW, which clobbered estimates. It's still down, but I believe something like 62% of European companies have beaten estimates, and it's a lot harder to beat estimates in Europe than it is here in the U.S. historically. Are analysts becoming too optimistic, though, at this point about European earnings? I mean, we're at record levels. We have EPS estimates that are continually upgraded to catch up with these beats. Are we at the peak?
I would push back on that a little bit. I think that, when you look at Europe's earnings this year, we're penciling at around 45% EPS growth for the Stock 600. 11 to 12% next year and high single digits the year after. So we think earnings can continue to climb in line with the macro backdrop where we see global growth remaining above trend out to 2023 and beyond. When it comes to investing in Europe, the key thing to remember is the other side of the equation, not just the earnings growth, but the valuation that you're putting on that earnings stream. And here we think the story is actually pretty interesting because when you look at European equities relative to US equivalents, both at the index level and below the index into specific companies, there is a huge and we would say unwarranted gap between Europe and the US. So at a headline level, that's a 22% discount. Historic average is around 15%. And if we go back to 2012, when we were coming out of the European sovereign debt crisis, we were back at 22%. So that to us feels like an opportunity for a bit of a catch up when it comes to European equities.
Europe, that's European equities. Talking about another region of the world, in China, we continue to see this regulatory clampdown rearing its head. Can you invest in China right now?
I think when it comes to headwinds for China, they are plentiful. Growth was already slowing, and now we have concerns around, infection rates rising again. You've obviously got the credit cycle, and throughout this year, but particularly coming to a head over the last week or so, regulatory concerns. So all of those present quite material headwinds when it comes to investing in China. But that said, again, let's go back to fundamentals of growth we think we can get out of the region, and what you're paying for that growth. And again, we do see opportunities pretty selectively, but we do think that there are opportunities in China. So we have been adding to portfolios on some of this weakness in the A-share market and in some of the internet names, with a healthy dose of skepticism attached to that, of course.
So adding when there's weakness in China, Grace, in your research, you write more generally about if there is a potential correction that you should have a shopping list. What's on your shopping list if we see a wider correction in these equity markets?
Yeah, I think the context here is that we haven't had more than a 5% pullback in markets, talking US European equities, since October of last year. That's not unprecedented, but it is quite unusual. So in terms of that shopping list, where would we be looking? First and foremost, we'd be looking to add cyclicality that also has secular supports. We're not so much in the pro-cyclical trades that are just beta driven now. We want to see some of the secular supports, around fiscal policy, infrastructure spending, spending play out. So that would be area number one. And the second area would be around growth at a reasonable price. So we're looking for mega trends, secular growth, where we've seen a real step change in prospects because of the pandemic. So digital transformation and the energy transition would be two pretty obvious areas, but we also see parts of the market exposed to, say, the circular economy, so waste, plastics, alternatives, sustainable fashion and industry. All of these parts of the market we think are incredibly interesting as well.
So that's your shopping list, kind of the buying on dip side of the equation. What about on the selling on rip side? Is there anywhere you'd be taking profit right now?
Yeah, totally. So we've got quite a healthy outlook when it comes to prospects for risk assets over the next 12 to 24 months. But that's not to say that we shouldn't be constantly reappraising and taking profits in parts of the market where valuations look a bit stretched despite those healthy fundamentals. So we've been doing that in parts of the high yield market. We've been doing it in US financials as well. And so they would be, where I would point to take some funds off the table and use that to rotate into parts of the market like Europe or some of those cyclicals and mega trends that I mentioned before.
Grace, always good to get some time with you. Thanks so much for joining us. Grace Peters is EMEA Head of Investment Strategy at JP Morgan Private Bank. Coming up, BMW's big warning. The car maker says chip shortage woes are not over yet. Or next, this is Bloomberg.
A gente estava há um ano sem se apresentar, as escolas estão começando a reabrir, os teatros não vão reabrir tão cedo. Aí a gente teve a ideia, no melhor estilo do Milton Nascimento, vamos levar a música aonde o povo está.
Minha missão hoje é fazer as pessoas sorrirem, cara. Sorrirem, olharem da janela, verem uma coisa inusitada, ficarem felizes, mandarem para os amigos e, enfim, curtirem um momento diferente, mesmo dentro de casa.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Global semiconductor shortage has been impacting us. And probably this quarter two will be very difficult for the old operation by knowing that the inventory level is quite low and how we can make sure to manage. So it is important to have the continuous monitoring the situation.
The chip shortage itself on the back of a rebounding economy after the pandemic or the depths of the pandemic, it's been quite a whipsaw for us in the industry.
So how long does it last? I mean, are you going to get things back on track, say, by Q4?
Well, you know, the chip information changes every single day, and it's a moving feast. But I do believe that our inventories as an industry will start to recover from later this summer, and so consumers will have more choice going into the fall and winter.
That was Mazda North America CEO Jeff Guyton and the CEO of Nissan speaking to Bloomberg as the global chip shortage continues to roil auto production. Joining us for more is Bloomberg Global Autos editor Craig Trudell. And Craig, we heard again from a big car maker, BMW, this morning saying that it's not over yet. And even though BMW beat the street's estimate for profit by 25%, the shares are selling off in Frankfurt.
Yeah, it's very interesting because BMW was one of the last ones to kind of buckle under this chip shortage. They were really sort of forceful in their language with, just how much they expected their suppliers to deliver. They felt like they, sort of saw this coming to some degree and made sure that they ordered enough chips to, keep production lines rolling. But they succumbed to this just like everybody else. And they do have an expectation that, rather than continuing to, largely stay above the fray, that this is going to get worse, which is something that, has, quickly become a consensus. I think there was an expectation that the second quarter would be, the sort of peak impact for the car companies. And that has changed more recently where they've, said, wait a minute, maybe third quarter might be, where we really see things hitting us hardest.
Craig, at the same time that they're dealing with kind of these supply chain issues, they also are able to raise prices as a result. And we saw Stellantis upgrading its profitability forecast because of that today. To what extent do the higher prices car makers can charge offset some of this pain from not being able to produce as many?
It's been really remarkable. You actually kind of wonder how much these car makers ought to sort of learn a lesson from this ordeal that, maybe it would be best if we weren't able to make as many cars as we wanted to, because, you look at the earnings power that they're managing. The inventory has been very constrained. They focused on their higher spec, higher end models. Stellantis, does not have a particularly strong presence in the luxury market, but, a lot of Jeeps, SUVs, and Ram pickups right now are selling for, top dollar, and that's really flowing through to the bottom line for them.
I mean, this is interesting to me because BMW, we're looking at them build an electric car right now. And, even the M cars have like 3-liter inline sixes. Stellantis builds these huge trucks, right? They have a Wrangler now with a 6.0-liter V8, or the Ram Power Wagon has that motor as well. They're not really very green, but they're selling for a massive premium. Isn't that a little bit ironic, Craig, that they're the ones doing so well?
Yeah, and BMW, to be clear, too, I think, they're seeing this. I think we've seen Mercedes talk about this. We've seen Volkswagen talk about Audi and Porsche really having a great first half. So, we're seeing this really kind of across the board, but with Jeeps, to your point in particular, I mean, we're seeing, Wranglers going for, starting at $40,000, $50,000, depending on the sort of trim and version. And that would have been unheard of just a few years ago. This is a company that's really taken Jeep to, significant heights in terms of sales. They're doing so, while boosting prices to a significant degree as well.
So we also have GM earnings on deck for tomorrow, Craig. What are you expecting out of them?
They've managed this much better than Ford has. I think there was a concern that there was going to be a significant difference between the two. And I think Ford actually sort of, to their own surprise, were able to get through the second quarter much better than they expected. They really kind of caught the market off guard, talking about, we think production may be 50% of plan. That didn't materialize. But, a very similar story with Stellantis, where you're going to see pickups and SUVs really driving North American earnings and being, where their bread is buttered. And that's going to continue through the rest of the year.
Craig, always great to catch up with you, and always great to have someone on who speaks Matt Miller's language. That's Bloomberg's Craig Trudell. Thanks so much. Now, coming up, we turn to crypto and the explosion of venture capital, part of our interview with Mark Andreessen Horowitz, co-founder from the latest episode of Bloomberg Wealth with David Rubenstein. Next, this is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Some of the best deals in history have been passed on by a very large number of people. The money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We view it as fundamentally a technological transformation. So there's a fundamental technological breakthrough that has actually happened, and it's an area of computer science called distributed consensus. So it's the ability for a lot of basically people and software on the internet to be able to form trust relationships in an untrusted environment. Money is one application of being able to have distributed consensus, but it's only one of those applications. There are many other applications, many other things that people are going to be able to do with this technology. And many of the smartest people in computer science are going into this field, and they're pushing it forward at a really rapid rate. So to us, it looks like it's just the 8th or 9th fundamental architecture change, breakthrough, technological transformation happening in the tech industry. And we take it very seriously because of that.
That was Andreessen Horowitz co-founder and general partner Mark Andreessen. And to hear more of his insights, you can watch Bloomberg Wealth with David Rubenstein tonight at 9 p.m. in New York. Well, Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. That begins at 6 a.m. in New York. And Tom, it's about 74 and a half hours until Jobs Day, I think?
Yeah, it is. We're going to start in 3 days. We got quiet markets today, but Kayleigh, we're really getting set up for this incredibly important, some say 1 million job formation report on Friday, Wednesday claims, and then we go, claims on Thursday. Wednesday, we've got ADP, that first look, and then on to jobs. The chart's real simple. This is the only chart that matters. That's according to Lisa Abramowitz. This is labor participation. And then I've taken it down, Kayleigh, to the core audience, 25 to 54 in America. And we're just not back to where we were before the pandemic.
You know, I always look at Whisper Go, Tom, on the terminal to see what people are expecting for non-farm payrolls. But it's also interesting to see that clients expect the 10-year yield to still be at 1.20 by year end. And we're seeing real yields at like negative 120 right now. Are you getting any kind of consensus as to why yields are this low?
No, it's not so much why yields are low. I would say, Matt, what we're focused on is what are yields going to do, and there is no consensus. This was a major theme yesterday. Farrow demanded that we do this theme, the idea of just the absolute mystery of not only where yields are through August, but Matt, how do they get to the end of the year, and what will that statistic be?
So much still unknown. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. Now let's take a look at what else we're watching today. And Matt Miller, you are watching masks.
Yeah, San Francisco has now reinstated mask orders indoors regardless of your vaccination status. And this seems to be, coming back, possibly even for here in New York. I know you point out that Mayor de Blasio hasn't said that he's going to move in that direction, but it could be that the private market does it for him. You know, that companies start to see, oh, even our vaccinated employees continue to get sick. Now we're going to start reinstating mask orders indoors. I think a lot of, as you pointed out earlier, Kayleigh, Apple has already done it. Alphabet has already done it. They're demanding that people get vaccinations, but it seems like masks. I was on the Metro North yesterday, up to Bronxville to look for a house, and I had to wear a mask the whole time.
He just had to get that in there, Danny.
In case anyone knows of one.
Is Matt looking for somewhere?
Do you have a place for me, dear viewer?
Come on, guys, you got to send Matt some recommendations because, we need him not needing to wear a mask at home with it off. I think that second order effects are interesting. Makeup sales for L'Oreal did really well. Maybe people will stop buying it if their faces are covered yet again. Anyway, I'm watching Gary Gensler from the SEC giving a talk on crypto at the Aspen Institute today, the Aspen Security Forum. He used to teach a class at MIT on blockchain and money. The Bloomberg Big Take today is on this. Recommend anyone read it. A good fun fact is that Goldman Sachs wealth advisors once boasted that they looked at 29 hours of his class and parsed through it. So this one will be parsed through too, Kayleigh.
29 hours.
That is a lot of
29 hours.
All right, well, I'm watching Alibaba earnings. They should be crossing around 7 a.m. Eastern time. Obviously, a major Chinese company and a big bellwether for Chinese stocks in general. And of course, this will be particularly interesting given the accelerating regulatory crackdown from Beijing that is affecting so many Chinese companies, has affected Alibaba. Remember, in the first quarter, it reported its first loss in 9 years because of that anti-monopoly inquiry. So it'll be interesting to see how those results shake out in just about an hour or so's time. More Bloomberg surveillance is still ahead. Stay with us. This is Bloomberg.
How do you assess the sector as a whole? Is it making a better case for itself at the right price at this point?
Most of the big hedge funds, most of the people that have been growing, have been delivering very good performance. We have, but so is a number of the peers. You know, it is definitely the hedge fund business is getting more about the large getting larger and generating more performance, being able to hire the best people, thereby generating better performance, thereby getting larger. So when you look at the performance of the largest, say, 20 or 50 hedge funds, the performance has been pretty good over a number of years, and the inflows have been pretty good. You know, this is another quarter of positive inflows for us. I think one of the bits you're seeing at the moment is every client is worried about inflation. When they say they're worried about inflation, what they really mean is, I own a load of bonds, is that going to cause me a problem?
Had an exceptional Q2.
It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
How are you navigating what seems to be a really tough situation better than almost anyone else?
We've worked hard on the supply chain. There's no question there's a lot of work to do in the supply chain for semiconductors. And we're happy that we were able to exceed our second quarter guidance as well as, guide up for the rest of the year.
I would argue the labor market is as tight, if not tighter, than any we've seen in decades.
We're already in an economy that has seen peak growth on a quarter-to-quarter basis and is beginning to slow.
We're seeing a Fed that's moving a little bit faster, a little bit further to pull back on these purchases.
The market kind of has this view right now that if the Fed starts hiking, they will not be able to get many rate hikes actually done.
It takes markets a long time to realize that something really fundamental has changed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market up 15 on the S&P, up 1/3%. And just in a moment, Tom, we'll catch up with an equity market bull looking for 4,700 on the S&P 500.
We're getting these conversations in more and more, and the research suggests higher earnings, better, up they go on the equity market. And I would call today, John, a resilient market. Nothing really sticks out, but but that's what you expect before a jobs report.
This week gets more interesting, Tom, as this week grows older.
Yes.
And let me tell you, that speech from Vice Chair Rich Clarida tomorrow, that's a big one after the division that's clear on the Board of Governors, with Governor Waller coming out yesterday swinging.
Right. Let's explain why this is, John, and this goes to our interviews that we've had with the vice chairman. Some of those interviews, frankly, rather heated. This is the great monetary economist of the leadership of the Fed. Powell is not an economist. Many of the others are very, very qualified, and Rich Clarida drives a theoretical bus at the Fed.
That's got to be the next stop for this market, Lisa.
Yeah, the Federal Reserve and how they're going to react to strong prints. My question, though, is are we starting to see a cooling off in some of the pressure, particularly within inflation? I mean, yesterday's ISM data really highlighting how supply chain disruptions are pressuring growth in a new way, John.
Should we get 10 cent up? Do you want to hit 10 cent quickly?
I want to hit spiritual opium.
Five
I
cent
mean, what
listens.
was going on? What was going on about that? There was an editorial, Lisa, that they pulled the link online to the editorial. This was the close over in Hong Kong, down 6%.
Yeah. Well, spiritual opium and electronic drugs. A state-owned media outlet of China included a criticism of video games as such. I mean, honestly, any parent who's lived through the pandemic welcomed spiritual opium and electronic drugs, which is the reason why we were all hooked to Fortnite.
I don't think you want to admit that on air, but carry on, please.
I think that if anyone does it, honestly, they're just being dishonest. A lot of parents are in the same boat, but there is a question. They're not wrong, but the idea here is that this is how they're going to indicate the next regulatory crackdown in this type of communication in state-owned media, and that is the response that you're seeing in equities.
We'll spend a little bit more time on this a little bit later. Let's get you to price action this Tuesday morning. Good morning. On the S&P 500, futures up 15, advancing 1/3% into the bond market. Yields higher by a couple of basis points to 119.54. In foreign exchange, Tom, euro dollar 118.83. We're positive on that currency pair at 1/10%.
Yeah, I mean, the markets again today are stasis, John, and that's normal into ADP and particularly into claims on Thursday. I'm just looking, John, at resilient equity markets and a dollar that, what's the dollar supposed to do? Strengthen? No, but it's resilient. It is really not weakened.
As yields are higher by 2 basis points on a session, Lisa, your 10-year 119.54.
All right, there's a lot of big data this week. However, there is some that's coming out today. And really the theme of the day, in my opinion, is a continuation of what we have been seeing. Supply chain disruptions, how much that is going to crimp growth on an ongoing basis. 10 a.m. we get U.S. June factory orders and durable goods orders. Yes, the demand is there. Are the supplies there? We are not seeing it in the same kind of way. How much are prices increasing? How much are factories competing for both the goods and the labor to get those goods in their doors? Then throughout the day, this is the other aspect of the story. We're going to be getting U.S. July awards, total vehicle sales sort of trickling out. And here we're going to see also supply chain disruptions and, frankly, auto chip shortages, which we heard from BMW overnight. These are all things that are adding to an outlook that is highly uncertain for automakers, even though you have incredible demand and incredibly high prices for cars. Anyone who's tried to go buy one, anyone who can drive, can actually go and see how expensive some of these cars have gotten. And then 3:45 p.m., President Biden is planning to speak on COVID-19, the progress of vaccination in the United States. Right now, the surge in Delta is getting increasingly concerning. In Florida in particular, just to sort of pinpoint one example, which accounts for 20% of all the diagnosed new COVID cases over the past week in the United States. Hospitals are seeing constraints. They're seeing labor shortages. They're seeing nursing issues because their crowds are just overwhelming. This is what people are looking for to determine what the next steps are and how critical this is going to get, John.
Lisa, thank you. Let's turn to the price action. An equity market bull looking for 4,700 on the S&P 500, raising his price target from 43 in the past 24 hours. And I'm pleased to say that John Stolfus of Oppenheimer Asset Management, the chief investment strategist, joins us right now. John, help us out. How do we get to 4,700 and why the upgrade?
Well, I think, Jonathan, first, thanks for having me on the show. Tom, great to be here. Lisa, great to be here as well. Just to let you know, when we look at it, it's that resilience of equities that we're seeing, the fact that we've got earnings momentum here, that even as the dramatic comparisons begin to ebb in the third and fourth quarter, will still show that companies are maneuvering very uncertain times. A lot of it done by, of course, use of implementation of technology and the innovation that comes with that.
John, how far out can you go when you look now at a guesstimate forward for equities? Can you go out 6 months with confidence? Can you go out 1 year with confidence? Can I get you out 2 or 3 years and Standard & Poor's 5,000?
Tom, I won't do 2 or 3 years out, but I can do 12 to 18 months. We feel pretty comfortable with the momentum of a $20+ trillion economy in the U.S., the resilience that has been the result of the Fed rescue program, and probably an overabundance of fiscal stimulus tells us that we've got a further upside here.
Lisa, that 18-month statement by Mr. Stolfus, I think, is a huge deal. There's very few people with that courage.
Yeah, the idea here going forward, it's going to be very difficult to have visibility. And John, one of the aspects of that visibility is supply chain issues, which we keep seeing in reports from companies, in particular the auto companies that we're going to see throughout the day. Have you factored this in? How do you factor this in? What's the time frame for when we stop talking about this?
Well, I think, Lisa, we have to take this in context. And the big problem is when you're coming out of a major crisis, you get these periods of uncertainty, but you have to take a look at and see how things have been done recently. Just think back where we were a year ago or in March or April of last year. Everybody was projecting very negatively because things were so uncertain. I go back to 2009, and as an early bull in 2009, what played out was the fact we looked and saw what the Fed was doing. We looked at corporations that responded positively to it, the strength of the consumer. All that gives you confidence in looking forward that we are likely to be headed towards an economic recovery that turns into sustainable economic growth in the U.S. at a modest enough pace so that interest rates don't rise so much to overthrow the equity market. Give it a jolt. There's always pullbacks, and mini corrections, maybe even a correction ahead. But the overall story is resilience. Tom said it. It's that resilience, and it's a factor that is backed by fundamental structures in the global economy, not just the U.S., but particularly in the U.S.
That sounds like a bedtime story for the equity market bulls, all right, John. That'll help them sleep nicely. Let me talk to you about something that's keeping some people awake at night, and that's the Delta variant. This is what Morgan Stanley had to say over the weekend. In the UK, a reasonable template for the US. Hospitalizations remained low as cases spiked. The economy reopened anyway, and ultimately cases have started receding, suggesting overstated downside risks from COVID-19. Do you think, in the words of Morgan Stanley, that is a reasonable template for the US, John?
I think it likely is, though. We've got to say, when you if you'd asked me what the biggest risks are here, we would say number one is the variant. And the fact that we still don't have enough people vaccinated in the U.S. with a second shot. In addition to that, the second thing would really be overstimulation by politicians in Washington that could bring about longer-lasting inflation, though we don't think the type of inflation that we saw in the late 70s or early 80s, which both Tom and I experienced, by the way.
Oh, thank you.
John Stolfus, Oppenheimer Asset Management Chief Investment Strategist. I'll invite you back, John. Don't worry, even if Tom doesn't. It's got to catch up, sir. Looking for 4,700 on the S&P from 4,300 previously. Your equity market with a lift this morning, up 16 TK. We advance about 1/3 of 1% on the S&P.
1/3 of 1%. And you wonder where M&A activity goes here, John. Just out, Dow Jones has this. This is PepsiCo jettisoning, John, the juice business. John, do you drink juices like, in America we used to have a glass of orange juice every day?
A lot of sugar.
It's
in
gone.
Some of those juices.
It's gone. Pepsi
so this is Tropicana.
Gone.
This is the Naked Juice brands.
Yeah.
The juice brands valued at roughly $4.5 billion. Is that a trim for the likes of PepsiCo, Tom?
Yeah, I think it is. That's a nice way of putting it. To PA partners with their heritage with Paribas of France. And, it's European private equity. But, John, this is important for the surveillance team. I mean, there was a period, John, in the 70s where you had to choose every morning Tropicana or Tang.
Yeah, this sounds really personal. This sounds really personal. Can I talk about something a little bit more personal to the Federal Reserve and Chairman Powell, maybe? And that was Governor Waller yesterday on CNBC saying the following. I think you could be ready to do an announcement by September. That depends on what the next two jobs reports do. If they come in as strong as the last one, then I think you have made the progress you need. Lisa, that really advances this story that maybe Payrolls Friday, this coming Friday, is a little bit more important than it might be for the likes of Governor Brainerd.
Well, and that seems to be what Chair Powell was indicating as well during the press conference. The question just is, in my mind, and you've repeated this again and again, John, which is, what is the market response? If we get a very strong jobs number, is that positive or is that negative for bonds, given the fact that a sooner hike, a sooner taper might crimp growth in the long term?
No idea is the answer to that. 875 is the estimate. I can give you that, and I can also tell you that's a moving target going into Payrolls Friday. Our current median estimate down from north of 900K, Tom, coming in at about 875 a few days out.
Yeah, after what we saw May 7th on the April report, John, I don't look at any of these surveys with any kind of belief. What's the standard error, John, after what we went through May 7th?
Well, let's talk about the range. It's anywhere from in and around 350 to well north of $1 million.
We're going to cover it. That's what I know.
Deep into the unknown, and that's what I know too, Tom. Full coverage coming up this Friday on Bloomberg TV and radio. Equities up 16 points, up a third of 1%.
This is a tang
We
show.
both know you don't start your day with orange juice. In the bond market, yields higher by a basis point or two, 119.38. From New York City, Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The surge in COVID cases is increasing pressure on U.S. drug regulators to fully approve the Pfizer coronavirus vaccine. It was the first one to apply for full licensure in the country. Approval could help the Biden administration ramp back up its immunization drive and reassure vaccine holdouts that the shots are indeed safe. The British government is seeking to limit disruption to industry from the so-called pingdemic. Authorities have changed the National Health Service's COVID mobile phone app so that fewer people will be told to self-isolate. The app will now notify only those who come into contact with an infected person within 2 days prior to the positive test. And that's instead of the 5 days. A key Senate Republican has tested positive for the coronavirus, and that could delay those Democratic plans to pass that infrastructure bill this week. Senator Lindsey Graham and at least 4 other senators attended an event over the weekend hosted by Senator Joe Manchin. Graham will quarantine for 10 days and miss votes on the legislation. If other senators test positive, that could delay the vote timetable. And at the Tokyo Olympics, American gymnastics star Simone Biles made an emotional return to the competition and won the bronze medal in the balance beam final. That came just a week after she withdrew from several events to focus on her mental health. The bronze was Biles' 7th career Olympic medal. She won it by drilling a slightly watered-down version of her usual routine on the beam. Global News 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature, it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
What we've learned in the intervening months is that demand is indeed very strong, but there have been some pretty severe supply side constraints. People are not flocking back into the labor force in the numbers that we had hoped, for the reasons that everyone suggested: health concerns, childcare issues, and the supplemental unemployment benefits.
Stephen Stanley, Amherst Pierpont chief economist, looking for the first rate hike at the Fed in June of next year. I posed that to Mike Schumacher of Wells Fargo. He said he's got the month right, the year wrong. There you go. Just one view. Tom Keene, Lisa Bramis, Jonathan Ferro. Or rather, two views, Tom. That does nail it. Equity futures up 17 on the S&P 500, advancing 0.4% into the bond market. Yields higher by a basis point or two to 119.21. Euro dollar firmer by a little more than a tenth at 118.88. Just want to bring you some comments from the St. Louis Fed president, Jim Bullard, telling Reuters that the Fed will have to cope with faster change, a more volatile economic regime emerging in the United States. And in many ways, it seems that the St. Louis Fed president is on the same page as Governor Waller and former head of research of the St. Louis Fed, Tom. Those two look like they're building a partnership on that Fed.
I would suggest, John, they're slaves to the data like everyone else. And we've got to see what the data is, starting with the key Friday determinant and also the wage dynamic of that. Frankly, the auto data will be interesting, even with the chip shortage. And it's just, John, it's a granularity of data that we're all going to have to digest.
Euro Swiss making a move, Tom. Just to bring that up quickly, a headline cross on a Bloomberg. Euro Swiss, lowest level this year. So that's some Swissy strength in the mix.
Yeah, and this is Swissy strength. And John and I tear up over this, folks, because this is how John and I met, was with Swiss franc moving here. And it's demonstrable.
There's a bar
John,
bill involved, Lisa. You won't be surprised with that.
I'm shocked.
Euro Swiss right now, 1.07. It's a move of 0.1%, but a gap lower in the last 10 minutes, Tom.
Well, there it is. Let's go to Washington right now. And what's so fascinating about what we see in the news, so yes, infrastructure front and center. There is the sign always in the summer when one topic overtakes all in Washington. Anne-Marie Horton knows that is the E word, eviction. Anne-Marie, how did we get here? How big a surprise on a summer Tuesday in August is that there's no other topic in Washington but the eviction of millions of Americans?
Tom, there's a lot of finger pointing here in Washington about this eviction. The White House last Thursday telling Congress you need to act before it expires in just 48 hours. But really, it's not a surprise given the fact that at the end of June, the Supreme Court had said this. So Washington had about a month to decide what it wanted to do and how to proceed. And right now, there's just a lot of blame going on and who should be responsible. The White House says it just doesn't have the legal authorization to act alone. Brett Kavanaugh, who actually voted with the progressives of the Supreme Court, that Justice Kavanaugh also put out a memo saying they have a month to the extension, and this should give the state and local authorities enough time to tap all of that funding, $47 billion worth for rental assistance, to help with these evictions. But right now, millions are facing eviction, and the White House is really just trying to hammer home how these state and local authorities could get that money out to landlords and renters.
Anne-Marie, let's talk about the infrastructure bill and the senator from South Carolina, Lindsey Graham. Senator Graham testing positive for COVID. We, of course, wish him the best and for a full, speedy recovery. Anne-Marie, how does this reshape, if any way at all, reshape the infrastructure talks and the passing of this bill?
Before the logistics, John, we also should note that the good news is that Senator Lindsey Graham also said on Twitter that without the vaccine, he is sure that his symptoms would be far worse. So he does feel like he is dealing with some minor symptoms. He was on the weekend gathering with other senators on Senator Joe Manchin's houseboat. So there is this cloud of worry that potentially there could be others that test positive. And unlike the House, the Senate does not have a proxy vote. So if he's in quarantine, he wouldn't be able to vote for the upcoming legislation if it was to hit the floor. That's potentially one key issue. Also, the fact that he was part of that bipartisan group, a very loud voice trying to push this through and also getting other Republicans on board. So there's a lot of interesting facets at play when it comes to this, because without his vote, potentially it could go through, but will other Republicans join in? And also, what does it mean for other breakthrough cases on the Hill?
Anne-Marie, what happens if they do not pass it before the August recess?
Well, what happens is potentially two things. They go home and just deal with it when they come back, Lisa, or what Senator Chuck Schumer has said potentially is that they work through August recess. There, in essence, is no vacation, and they will work to get this infrastructure bill through.
I'm just digesting. In essence, there is no vacation.
I thought you were in shock, Tom, because I just saw reports coming from London that Harry Kane was absent for training again.
Oh, dear
Lord. I've been looking at that as well.
Day.
I mean,
I thought you were distracted.
There's a lot going on here that we're distracted by. But Anne-Marie, I look at the infrastructure bill and all here. What does the end of your week look like? I can't get a clue on the actual zeitgeist of the end of the week in August.
It's very difficult to see what the end of the week will look like, because every day there are these wild cards. For instance, yesterday, Senator Lindsey Graham getting COVID. The fact that you now also have this eviction moratorium obviously taking a lot of the space of the discussions that are happening in Washington. You have Treasury Secretary Janet Yellen will be speaking to House Democrats today about the eviction moratorium. All of while they are trying to get infrastructure through. They want amendments on the floor. Senator Chuck Schumer wants a vote by the end of the week. We'll have to wait and see if he's going to get it.
Anne-Marie, good to catch up. Anne-Marie Horden, our Washington correspondent down in Washington, D.C. Are you read in now, Tom?
Yeah,
on what's happening in North London?
I'm read in. There's like so much going on here. I mean, Harry, come on, John. How can he abrogate his contract?
It's what Lisa does every morning. Threatens to sit out the show to force a change of shows, Tom. She wants to get to a different program. Maybe around lunchtime. Hates the early starts.
Okay, John, full disclosure, I was not read in on 10 Cent and the opium of games. Lisa and I have been going back and forth. And, John, it's the pendulum of Parcheesi. These kids have got to get off their games and get back to real board games.
Okay.
In the summer, you waste an entire day playing Parcheesi.
Lisa, the floor is yours.
I've spent so many hours playing Parcheesi that I'm cross-eyed.
Can you let me know what Parcheesi is? Because I have no idea what it is.
It's a board game. You try to get your pieces into the home base, and you've got 4 or 5 pieces, depending on who you play with.
And this is what the boys play?
They did, and then the pandemic hit, and, you outsource parenting while you try to work to video games, which is an opium or drug or whatever the Chinese official media. They're not wrong. We just try not to talk about it too loud.
John,
regulatory fears in China, though. The fact that got pulled so quickly, in the online edition. Anyway, Lisa, speaks to maybe the reporters there going a little bit too far. That's what I've heard from the team here at Bloomberg this morning.
I wonder how coherent their effort is, how much they understand what the ramifications of their words, I'm talking about Chinese regulators, will be on markets, how sort of calculated this is, because it feels a bit haphazard, if you will.
I'll catch up with Wei Li of BlackRock, and Wei Li's pointing out that she doesn't think this stops anytime soon, but she thinks the effort will fluctuate over time, and that they'll soften the blow here and there with a loosening of policy. On the economic side, at least, and that's something we need to get our teeth into. Let's get our teeth into this market, Tom. The S&P 500 with a lift up 0.4%. John Stoltzfus of Oppenheimer on this program 25 minutes ago. TK looking for 4,700 on the S&P.
Stoltzfus is, bullish. He's been bullish. He's had the courage to be in the market. Also, Stoltzfus played Parcheesi, so that's a good thing.
43.87 was the close on the S&P yesterday. This show, seriously, from New York City for our audience worldwide, a beautiful New York, on TV, on radio. This is Bloomberg.
If inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
I assume you have a lot of people saying the food isn't as healthy as they might want it to be. Is that the biggest challenge, or just growing the company?
Ray Kroc had a famous line, if you're not green and growing, you're red and rotten.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Live from New York City for our audience worldwide, here is the Tuesday morning price action. Good morning to you. Equity futures advancing by about 1/3 on the S&P. On the Nasdaq by a little more than 1/10. The small caps outperform, up 0.7%. John Stoltzfus and Oppenheimer on a show 30 minutes ago, looking for a move to 4,700, an upgrade from him in the past 24 hours from 43. The call is on the fundamentals. So let's talk about the fundamentals and this market. Switch up the board and get to the bond market. 2s, 10s and 30s. BMO for me with the line of the past week. How much this Treasury market trades on the fundamentals is as much of an unknown as the fundamentals and the incoming data itself. Your yield right now, a breakdown yesterday, 119.21. Yields are higher on the morning by about a basis point. They are well off the highs of the year of pushing 170, 180 on a 10-year at the back end of March. Right now, 186.38 on 30s. The real question for me at this point is, can you really look at a Treasury market in a vacuum focused purely on the fundamentals in one country when this is happening elsewhere? Switch up the board and get to the Bund curve. 2s, 10s, 30s. Every single part of this bond market in Germany yesterday was negative.
Yeah.
With the 30-year yield below that zero line, Tom, for the first time since February, and right now 0.005%. I just don't think you can, and many people agree because it's just stated the obvious. You can't take the Treasury market and say it trades purely on the fundamentals of the U.S. economy when you've got this happening everywhere else.
John and I channeling this morning. I look at the Swiss 20-year as a proxy on that. And, John, what's so important here is they're really buttressed about new lows, new greater negative. It's a little bit different than what we see in the United States.
Yeah, just breaking down over in Germany. And Tom, we were talking about maybe getting closer to zero on a German 10-year, and we're back to -47, which is basically in line with the policy rate of the ECB of negative 50 basis points.
It speaks to the economy's under view here. And, of course, jobs on Friday will give us the American view, a real update there. Right now on that report, Joseph Livornia joins us with Natixis CIB, their chief economist for the Americas in his public service at the White House recently. Joe Livornia, I want to talk to you about the mystery of this August, the mystery into Q4 as well. How opaque is your Q4 right now?
It's somewhat opaque. Look, the economy's done very well in the past 4 quarters. GDP growth has been over 12%, but I've been of the view that the economy was at peak growth around Q2 and things are going to moderate. But even so, Tom, it's hard to see growth still not being really robust in the fourth quarter. I'm more worried about growth in 2022, and that's what the U.S. Bond market and global bond markets are sensing, that growth is going to weaken quite sharply with this bull flattening. And inflation will be transitory. That's what the markets are telling us.
That's what the markets are telling us. And is it a weakening back to potential GDP or let's say 3%? I mean, what's the level of weakening, the scale you would presume?
This year growth, I thought coming in, we'd have growth at 7, maybe even 8%. But next year, I'm thinking growth is only 2%, maybe even less.
Wow.
Which isn't far from the administration's longer term forecast. And that reflects the fact that we're borrowing from the future because we've had people that have been unable to spend until recently because of the pandemic. They've been locked up. They brought spending forward. We see that in goods purchases, which are about 4 to 5 points above their long-term GDP trend. And it's been predominantly consumption-led. Consumption in the last 14 quarters, if you look at 14 months rather, Tom, from when the savings rate went from 34% now down to 9%, we've had annualized consumption gains of 21% real. That's amazing. It's mostly in goods. So we're borrowing from the future, and that's why growth next year will slow quite sharply.
Joe, let's take your view of the world, and I'll ask you a basic question. How do you think the Federal Reserve operates in the kind of environment that you've just described?
They don't do anything, Jonathan. They stay on hold. They continue to pump liquidity in the system. They don't taper. They don't tighten. What we've seen continually since those late March, early April highs in 10-year yields is the market pricing the terminal rate significantly lower. That five-year OIS we've talked about was around 240 back in early April, thinking the market would basically, or the Fed rather, would tighten rates like they did in the last cycle. And just the other day, we were below 150. So the market's thinking the Fed does nothing.
Yeah.
And my guess is we don't get a tightening until after the next presidential election.
John, and then this goes right to the heart of what you mentioned before, which is the gentleman from St. Louis disagrees, just flat out disagrees with Joe Livornia.
As does the former head of research, I imagine, over at the St. Louis Fed as well. Joe, you said
That's okay.
no tightening.
I don't mind being the other side of that, Trey.
I imagine you don't mind that at all. You said no tightening, no tapering. You don't think we get a taper here, Joe, at all?
Not until we know what the contours of a budget deal look like, because the Fed will treat a lack of a deal as being contractionary. And even though we're in the midst of debating what happens on the infrastructure side, the bigger part of the package is this family welfare bill. And we're not going to know what that looks like if we get it, and it will likely be through reconciliation until maybe mid-October, early November. So, no, I think the Fed's going to sit and wait, see how things evolve. And it's going to be really hard, Jonathan, for the Fed to taper in a slower growth environment, and especially if over the next few months job growth slows, which I expect as well.
Just fascinating. Joe and Lisa, this won't be lost on you. No tapering. The other call there, no rate hike until after the next election.
Yes. I just want to add one other thing. You know, that sounds aggressive, but if you look at the last two cycles, the average time from the last rate cut to the first rate hike was 7 years. So this isn't really that unusual if you look at the last couple of cycles.
So, Joe, why are some people wrong who are saying that the balance of risks is to much higher inflation, especially with the Fed so dovish and so willing to wait? What is wrong with that call? Because it seems like you disagree.
Yeah, well, the thing is, we've never had basically a global lockdown of the economy where we've gotten these bottlenecks. And, of course, demand has been much stronger than people expected. The government has provided a tremendous amount of assistance. So it's easy to see why prices are rising. If there's a concern on inflation, and if I'm wrong on inflation, it's because perhaps we just spend too much. This is sort of the Larry Summers argument. And maybe evidence of that is seen in what the CBO next year was saying the output gap looks like. They're forecasting an output gap of almost 240 basis points, meaning the economy is 2 points above its long-term potential. That's the highest since '71. So it is possible, if we get more fiscal stimulus, you could build this inflation dynamic in the system. But I think most people just aren't fully appreciative of the unique situation we're in and the fact that much of the liquidity we've had to this point has gone into assets, both equities and, of course, real estate.
Joe, I hate to use the word transitory, but let's talk transitory. And at what point you start to look past some of the near-term influences on the economy? I'm talking about supply chain disruptions. The gentleman from St. Louis, as Tom said, was highlighting this as one feature that forces monetary policymakers to be more nimble. How do you factor in some of these disruptions that seem overly persistent and persisting longer than many people had expected?
Yeah, I would just give it time. I mean, the thing is, we saw with lumber, for example, which was the poster child for bottlenecks, where prices have basically collapsed as the mills were able to reopen. And I've argued we're going to see that more on the semiconductor side and other parts of the economy. It just needs to take time. The expectation side of it's important. And when we look at the tips curve, that tips curve is actually inverted. So it's not to say the markets are always right. There's just no evidence that anybody believes this is permanent. And because expectations oftentimes can be self-feeding and self-sustaining, those expectations are very likely to keep inflation low. And then as supply comes on, you'll start to see those prices moderate.
Joe, none of this is in the economic textbooks at Vassar. This is all absolutely original that we're dealing with right now. How do you interpret the real yield? Are you looking at the nominal rate? Or are you taking out the inflation expectation? Which of those two dynamics will adjust the real yield?
Well, I would say just focus on the real yield. The real yield has been falling as inflation expectations have edged up a bit. And that's sort of evidence, Tom, right there. The market does not believe that you're going to have very, very strong growth going forward. It's I hate to say these words, but it's the secular stagnation thesis. That's really what the market's saying. And you see it more broadly just in the slope of the curve, as you highlighted, both in the U.S. and Germany and elsewhere. You've got a bull flattening of the yield curve. So that's really not an inflation story. It's a growth story. And, of course, equities benefit from the fact that there aren't any alternatives, and there's a tremendous amount of liquidity in the market.
Joe, fantastic to catch up. Some really interesting calls there.
Jonathan.
Joe Livornia, really good to hear from you, sir. Natixis CIB, Chief Economist for the Americas. Within 24 hours, we've had two widely different views. Stephen Stanley of Amherst Pierpont looking for the first hike of June next year. And then you've got Joe Livornia there, Tom, talking about no hike through the entirety of this first administration from President Joe Biden.
Yeah, well, and it's the in-between that's of interest as well, John. I just think it shows where we are and how original this natural disaster is that we're living. And I'm sorry, I'm not into giving an opinion here in any way, shape, or form. We don't know.
Following the data, and I have to say highly anecdotal, but some of the signs that came out of yesterday's ISM, slightly encouraging in the industry commentary that we got, Lisa. This line stood out for a lot of people, at least. Supply chains are slowly, very slowly filling up. like a water hose starting upstream and slowly flowing downstream. Rumour is a full return to normal, maybe nearer to year's end, but the situation is progressing. We need to hear so much more of that through the next several months.
You also saw a moderation in how much prices were going up. Just to speak to that point, this idea that some of these pressures do seem to be moderating and really speak to Joe Lavorgna's point, which is that these issues are temporary. I do just want to say, though, that it all depends on inflation, what you think the Fed will do, and whether we're in a new regime or we're going back to an old one, where it's a series of lower lows when it comes to the neutral rate, just based on how much debt there is, John, and how much there is to risk if you raise rates too quickly.
Well, clearly, Joe thinks we're going to be waiting, Tom, a long, long time.
Yeah, I'd wait a long, long time. I mean, I don't think that really outlines what he said, John. A long, long time for Joe Lavorgna is an outlier.
Through 24 and into 25. Yeah. Look, we went there last time around, didn't we?
Well,
took a long time to wind things down.
Come on, it's a great missed call, John. It's a great missed call of the last number of years.
Well, look, Tom, the issue
now.
that people are raising this time around is that we have a set of policymakers conditioned by the previous cycle who are implementing policy based on the mistakes they made previously for a cycle that is radically different and moving at a very different pace. That's the argument anyway.
When yields broke yesterday, you and I were looking at 2-10 spread to go to 0.99. I mean, that's where we are.
Yields right now still sub 120 on 10s, 119.71. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Futures up 17. We advance 0.4% on the S&P. In the FX market, euro-dollar firmer by about 1/10% and change to 118.86. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden and top White House officials are trying to stave off a wave of evictions. A federal moratorium on evictions just expired, and the president is pressing federal, state and local government agencies to act quickly to stop tenants from losing their homes. The chair of the Securities and Exchange Commission is preparing more oversight of cryptocurrencies to protect investors. Gary Gensler has unusual expertise in digital assets, but in an interview with Bloomberg, he signaled that he's not on board with the hands-off oversight approach many enthusiasts would like to see. He says that investors must be protected against fraud. A Labour union may get the chance to reverse its loss to Amazon. Bloomberg's learned that a federal official has recommended overturning the results of a union election at an Amazon warehouse in Alabama. The National Labor Relations Board hearing officer says the election should be run again. Amazon can appeal that decision. The union accused the company of making anti-union threats. And Standard Chartered overcame economic headwinds across Asia to beat second quarter forecasts. That's allowing the bank to buy back shares and plan a small dividend. Standard Chartered's bottom line was boosted by reduced credit losses. Meanwhile, the wealth management unit posted a 26% increase in operating income. In China, shares of Tencent fell as much as 11% today. An offshoot of China's official news agency referred to video games as spiritual opium and electronic drugs. That stoked fears that Beijing will next set its sights on online entertainment. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Some of the best deals in history have been passed on by a very large number of people. The money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
We want to strongly recommend that people wear masks in indoor settings, even if you're vaccinated. Now, this is particularly true, of course, if you might be around anyone unvaccinated.
I believe it's in your business interest to run a vaccine-only establishment. It's very simple. You can operate a restaurant and just say, you have to show that you were vaccinated when you walk in the door.
New York City Mayor Bill de Blasio and New York Governor Andrew Cuomo on a difficult moment for this country. Another shift in the past week. From New York City this morning, good morning. Alongside Tom Keene and Lisa Browitz, I'm Jonathan Ferro. Your equity market, the S&P up 0.4%, advancing 16 points. Into the bond market, yields higher by a couple of basis points. Still sub 120 at 119.54. And the euro trying to get back to 119 again. Euro dollar positive, almost 0.2%. TK euro dollar 118.89.
Yeah, I like watching euro there one night. You know, through 119 is a big deal, John. A test of 120 would be a huge deal. The other thing I'd note here is the VIX 18.69 shows a stasis before the American labor reports of Wednesday, Thursday, and Friday. This is an honor. Christopher Bayror is someone who puts travel to work out of Hobart and William and Smith College ages ago and downstate. He holds court at Johns Hopkins in the Bloomberg School of Public Health, is a lead epidemiologist. We're thrilled that Dr. Bayror, with his international perspective, could join us this morning. Let me go local if I can, Dr. Bayror, which is the idea of the mayor of New York City and the governor of New York State saying, public enterprise, get your act together. Is there a history in a pandemic that public enterprise can provide public health policy?
Well, you know, what we really, of course, want to see is the federal government leading on this to have consistency across the states. But we've never had that in response to the coronavirus. And so I think what you're seeing is that people are reluctant to speak to the need for national mandates on masking, on immunization. And so it really has been up to much more local entities and the private sector to step in. I think what you're seeing is that we know these vaccines are highly safe and effective. These are the vaccines with emergency use authorization. And our only way out of this is much higher immunization rates than we've been able to achieve. But in the absence of doing better on vaccines, we are going to see things like vaccine mandates in the private sector.
If a senator, Mr. Graham, if a pitcher, Mr. Cole of the dreaded New York Yankees, if they get COVID, but we rationalize that they'll be fine, how does that fit into this mix?
Well, the important thing to remember is that these vaccines are holding against the variants in terms of hospitalization, pneumonia, death. But as it turns out, people who've been immunized can still get COVID, as Senator Graham did. And unfortunately, it looks like they can also transmit it. So they're likely to have a mild, much attenuated course, but still to have it. What that means is masking is still important. The senator is self-isolating now for 10 days. That's the right thing to do because he could very well be infectious for others. What's not happening is that he's not getting pneumonia and he's not in the hospital. When we look at who is in the hospital and who is on a ventilator, it's overwhelmingly the unvaccinated. And that's a tragedy.
Dr. Byrer, we've heard from Tony Fauci of the National Institute of Health that we're probably not going to see additional lockdowns. And yet in Florida, we're starting to see constraints on hospital staff as they deal with a surge in intake and patients coming in their doors. What's the potential threshold at which point this becomes a public health problem once again? We don't want to go back to a time when you're starting to set up tents and hospital beds outside in order to deal with the capacity.
Well, you know, we were down to about 12,000 infections a day. We're now back to 80,000 infections a day. And that is largely because of this much more infectious Delta variant. We had seen really a stalling in the vaccine effort, but it has been picking up in the last 2 weeks or so. Fortunately, people are really starting to move. As far as lockdowns and shutdowns, I think Dr. Fauci is generally right. But the exception to that is likely to be where vaccine coverage remains too low, places like Florida, other states in the South. We've already seen Missouri and Arkansas with low immunization coverage having high hospitalization.
Yeah. Dr. Byrer, the emotional effect of going back to wearing masks was actually greater than I thought. I was speaking with my colleague here about that. A lot of people wondering, are we going back to an era that seems endless the way it did a year ago? And there's a question, how long has the pandemic been prolonged as a result of the Delta variant?
Oh, there's no question that it's been prolonged. It's not just the variant. The reason that these variants can emerge is because there are so many susceptible people out there. And we have to remember that as challenging as this is in the US, in much of the world, there's virtually no efficacy, no high efficacy vaccines available. People are using the Chinese vaccines, which are not holding up well against this variant. They're using AstraZeneca, which also doesn't hold up as well. So what we really need is high efficacy vaccines with high uptake. Otherwise, we're going to see more variants. There's already a new Lambda variant that is emerging that may be a variant of concern. This is going to keep happening as long as there are so many susceptible people. So our way out of this is to do much better with immunization and to do much better with the high efficacy vaccines, the mRNAs and the J&J.
Doctor, just quickly, is the experience of the UK in the last couple of months a decent template for the United States?
Well, I think you're seeing there, Britain is already thinking about and moving toward a booster because of concerns about waning immunity and the need to protect the population. Apparently, China is also looking at boosting with an mRNA. Israel is planning on looking at a booster.
The reason I ask that, of course, Doctor, is because cases have rolled over quite significantly over the last couple of weeks. And that's what I mean by saying, is the UK a decent template for what we might experience here in the next several weeks through August?
Well, it certainly could be for much of the country. The immunization rates have been high in the UK. We still have areas that have much lower rates of immunization and where the UK might not be a good template, like Florida.
Interesting. Doctor, appreciate your time, sir. Thank you. Dr. Krista Byrol, Johns Hopkins Bloomberg School of Public Health professor and epidemiologist. Your equity market looks like this, up 16 on the S&P, advancing 1/3%. For the market strategists out there, Tom Keene, there are many, including Morgan Stanley, who look to the UK as a template for the United States. And for that very reason, many people in this market still constructive about the near term, because of exactly that.
Yeah, well, I think the constructive wing is tangible in the developed world. It's still there. But to me, John, it's news day every day. And I think the significance yesterday of Mayor de Blasio and Governor Cuomo reading the riot act to the restaurant business to get their act together, vaccinated, unvaccinated, was really critical, certainly for the Eastern Seaboard.
Do you think the mayor of New York City has a decent relationship with private organizations, private companies, Tom?
Oh, it's
to
phenomenal.
Try and make that happen?
I think it's sterling. I think it's a sterling
relationship.
Good
enough?
Yes.
Ooh, the sarcasm.
Isn't that sad, though, that for the moment we're in right now, Tom, that relationship would really matter? It would really count, and it hasn't been built up. Lost for words. Okay.
Silence.
You tell me in a commercial break what you really think. Tom Keene, Lisa Bravitz, Jonathan Ferro. Joining us shortly, out of hand of Wells Fargo. Equity futures up 16.
We should get a Parcheesi
advancing
board.
4/10
really?
of 1%. On the S&P 500. John Stolfus of Oppenheimer looking for 4,700 on the S&P. From New York City this morning, good morning. This is Bloomberg.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tianyi Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y-12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance and more.
2022年完成空间站的在轨建造，建成国家太空实验室。之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station.
出发，是，敬礼。
China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
had an exceptional Q2.
It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
I would argue the labor market is as tight, if not tighter, than any we've seen in decades.
We're already in an economy that has seen peak growth on a quarter-to-quarter basis and is beginning to slow.
We're seeing a Fed that's moving a little bit faster, a little bit further to pull back on these purchases.
The market kind of has this view right now that if the Fed starts hiking, they will not be able to get many rate hikes actually done.
It takes markets a long time to realize that something really fundamental has changed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market up 17 on the S&P, advancing 0.4%. We've had a little look at 4,400 over the last month or so, Tom, on the S&P. The calls keep coming through, 4,700 from Oppenheimer in the last hour on this program.
Well, the lift is there, and that's a measured lift out, a measured amount of time. Of course, 5,000 is a big figure for Standard & Poor's 500. John, a Dow equivalent to SPX 5,000 is just under Dow 40,000. Call it 39,500.
Thanks for that value add.
But seriously, John, nobody's framing this. Nobody's framing out beyond Q4, maybe summer of next year.
Well, let's frame the debate right now. We had a guest on this program yesterday, Tom, Stephen Stanley of Amherst Pierpont, saying first hike June next year.
Yep.
We had Joe Livornia of Natixis on this program 30 minutes ago saying first hike, it's not going to happen through the next 3.5 years. They are radically different calls, and both individuals are looking at exactly the same economic data.
You fold that into the markets, John, into the rate market where money's made and lost, but particularly into the equity market. And it's a vision thing that surveillance is struggling with now here to the end of the summer. And I would say into autumn. We got to get through August, but then how do you frame June of next year? And the answer is, if you're a bull, you go to SPX 5,000.
Yeah, I kicked off yesterday by kicking off the month of August by saying, Lisa, this is the road towards September. That's all August is.
Yeah, although you hear from Fed officials that maybe September is the road to October when we get the data for September.
If you're Governor Brainerd, yes.
I mean, that's the issue, is at what point do you have a world that you can look at and actually assess? And really the key metric here is inflation. People wondering, and really the dissonance that you're seeing on the sides of a rate hike next year or a rate hike in 3.5 years is, are we going to get a new inflationary regime post-COVID, or are we going back to the old regime and then some with the load of debt that we have hanging over us?
Is it fair to say the week starts tomorrow? Vice Chair Clarida, Tom, coming out tomorrow with a speech. ADP report claims Thursday, payrolls Friday.
No, the Clarida speech has got to be there, because is he going to put Bullard in the timeout chair? I mean, that's what this comes down to.
Does he bring Jackson Hole alive again after Governor Brainerd poured some freezing cold water over it over the last week too?
John, are you selling you need a trip out to Jackson Hole?
No. I won't be around for Jackson Hole. Your equity market up 16 on the S&P.
S&P
500 futures
up
0.4%. Nobody needs to see that. Yields are higher by a basis point or two to 119.21. And euro dollar, Lisa, having a little look at 119 again, up 0.1% on that currency pair. Euro dollar positive. The euro 118.85.
John, that was kind of ominous. I won't be around for that. I mean, you're going to be on vacation. It's not a serious thing, unless you want to go.
Not as dark as you. No one took it that way.
All right, let's move on.
Please do.
10 a.m. We get U.S. June factory orders and durable goods orders. Interesting to see the demand from factories. Also, whether we start to see some of the inventories build up, whether orders continue to be strong. Really, again, a key measure on some of the supply chain disruptions. Are they starting to ease in tandem with what we saw yesterday in the ISM manufacturing survey? Let's not overstate it. easing a little bit, but still a good trajectory. Also today, throughout the day, we're going to get U.S. July awards, total vehicle sales. The key issue here is how much are they slowing because of a lack of inventory on dealership lots. And this has been a theme. We hear that the road ahead is going to be rocky because there continue to be auto chip shortages. Is there any sign of that rolling over? Also, what are some of these sale prices like? This is what's kept profits very high despite some of the shortages that we've seen. In 3:45 p.m., President Biden is planning to speak on COVID-19 and the pace of vaccinations throughout the country. Interesting to see what he says about mask mandates, also trying to pressure the private sector, John, to take a more active role in mandating vaccinations for access. We see them looking to the private sector to take the lead role, as frankly, it continues to be a mystery as to what the legality of a federal mandate really is.
Lisa, really important stuff still ahead of us. Thank you. We talked yesterday about the comments coming from the team over at BMO on the bond market. The extent to which treasuries will be driven by the fundamentals is as much of an unknown as the actual data itself at this stage. This is the line from Wells Fargo on the economic data. Economic data continues to be in the eye of the beholder. Anna Han joins us now, Wells Fargo Securities equity strategist. So, Anna, let's talk about that. What does it mean for an equity investor, the incoming economic data of the moment?
I think what it means for us is that it can be interpreted sort of how you want to see the picture. In the eye of the beholder, what I mean by that is that sometimes you look at this economic data, you can be really concerned. Is growth slowing down? Is the amplitude of future economic GDP growth slowing down? Will that extend the cycle? And in that case, is that a concern on why maybe real yields are pulling back? Because people have a concern about whether full employment can be reached sooner. On the other hand, there are a lot of still bright spots in that economic data that support this reflation trade. I think it depends which camp you're in.
And your research note is fascinating in its physics where you talk about amplitude. I want to take it over to an even larger idea of magnitude. For the bulls out there in the equity market, what are the magnitudes that get you out to the emotion of SPX 5000 or the emotion of Dow 40,000?
You know, those are big, beautiful, round numbers, Tom, and people love those shiny numbers. I think to get there, what you really need to see maybe two fronts. One is that when you have these kind of yields retreating, you see this kind of natural effect for a discounting model for equity growth, for equity earnings. But on the other hand, that comes with this sort of ominous side of, well, growth is slowing down. Is it sustainable? But to get that yield, people may be reaching into equities. On the other hand, to really push equities, and I think what's been driving it more recently, is expectations and estimates. As we've gone through earnings season, you've seen corporates very focused on what do these input costs mean for my margin. And for the companies that are able to pass along that price and those margins can remain fat, then you see that they're able to continue seeing some price appreciation. I think it's that upward expectation and estimate revisions that we're really keeping an eye on to get there.
And specifically, just to dig in a little bit more, Anna, you noted in your recent research that earnings estimate revisions continue to trend higher, especially for value sectors. So why is this not being reflected in outperformance of these particular areas when you see growth surge ahead over the past month or so?
I think growth surgence recently has been a bit of that move in nominal yields. And what's interesting is that nominal yield move has been driven by real yields, but the inflation expectation baked in, at least the 10-year, has remained, well, rather steady. So you see this growth trade has had resurgence as yields pull back. The question for these value stocks is this reflation going to be a concern? And that uncertainty, I think, still weighs on it, that additional risk premium that you have to bake in. But when you look at estimates, you're right. These value sectors are really what's pushing the estimate revisions. And if that continues, and if that expectations or these revisions can continue outpacing what investors want out of it, I think you will see that eventual appreciation later down the road.
Anna, what leads to the downdraft? You and the team with Chris Harvey looking for 38.50 on the S&P. We've had the 4,700 view just about an hour ago. What's the 38.50 view?
Well, if you remember us coming into the year, we talked about low volatility and defensive strategies come summer. And look what's happened in the recent month. We recommended a tactical pivot into low volatility strategy and style because a pullback in yields could cause some of that volatility. And for us right now, it's not that necessarily our longer term view on reflation has yet changed, but we like to say, be careful of perception becoming reality. Once the market really starts to doubt the potential for reflation, the potential for growth, that can kind of spiral out of control. So for us, the reason we remain cautious is that we're seeing signs of concern, and that can really have a sort of negative and spreading effect amongst investors. So it keeps us a little bit more cautious and on our toes.
Earlier this year, Anna, we were pointing to retail investors as the potential swing trader when it came to certain big moves in equity markets. Are they still players, or have they all gone back to taking vacations and not dealing with the Robinhood accounts?
Well, I think they are definitely still a player, and they may be even growing as we go several years forward. However, for now, I think a lot of the flows you're seeing and that's been dominating more in the fixed income markets has been more institutional side, has been your bigger fishes or whales in the ocean here. But when you look at equities, a lot of this sort of risk-taking or risk seeking was pulled back last month, given the additional concern about potential for full employment to be a bit further down the road. And as that risk appetite wanes, I think you may see the retail crowd be a little quieter and maybe may sit down a little bit in the stands.
Anna, good to catch up. Always good to hear from you. Anna Hand there of Wells Fargo's equity strategist with Chris Harvey and the team, looking for 38.50 on the S&P 500 year-end, Tom. Once again, framing out the story to 38.50 all the way through to 4,700 on this programme over the last couple of hours.
You know, it's healthy to see this, and frankly, John, in the dead of summer, maybe that's what you see, but this isn't a normal summer. And again, I go back to maybe what we'll hear from Vice Chairman Clarida, that they are beyond data dependent. He'll phrase that in his own elegant way. But, I mean, they're hanging on every data point.
How close will Vice Chair Clarida's speech be to what we heard from Governor Brainerd on Friday going into the weekend? Lisa, I think that's the big question for this market. If we get a Governor Brainerd-type speech from Vice Chair Clarida, that's a big deal.
It means that perhaps he's aligning himself with someone he sees as being the next Fed chair. I mean, how much does that sort of
you went
indicate?
straight to the politics. I was going to the markets, but carry on.
I mean, well, the idea is, where is the balance of weight? We were talking about the big three, right? Rich Clarida, John Williams, and Fed Chair Jay Powell. Well, at this point, does Lael Brainerd become one of the big four as she starts to step to the seat?
I think anyone on the Board of Governors should be on the same page. Typically, they are. That's not my view. I think many people believe that is the case, Tom, that they're all on the same page. And that's why the speech from Governor Waller, the interview with CNBC yesterday, it was quite interesting to see him break with the core of the Fed.
You two are all Bridgerton. I mean, Lisa, you're looking at the Fed like it's an episode of Bridgerton.
I've never watched Bridgerton.
I mean, that's all there is to it.
Lisa has. Lisa, can you say this is like an episode of Bridgerton?
I don't know what you've been watching, Tom. This is not like Bridgerton at all. What's in that tang?
That is not an episode of anything I want to watch. Bond market, Fed drama. I'll take a pass. Yields higher by a couple of basis points to 119.54. Equities up 0.4%. I don't know if that's a good thing or a bad thing, Tom. From New York, this is Bloomberg.
With the first word news, I'm Ritika Gupta. The surge in COVID cases is increasing pressure on U.S. drug regulators to fully approve the Pfizer coronavirus vaccine. It was the first one to apply for the full licensure in the country. Approval could help the Biden administration ramp back up its immunization drive and reassure vaccine holdouts that the shots are safe. A key Senate Republican has tested positive for the coronavirus, and that could delay the Democratic plans to pass that infrastructure bill this week. Senator Lindsey Graham and at least 4 other senators attended an event over the weekend hosted by Senator Joe Manchin. Graham will quarantine for 10 days and miss votes on the legislation. And if other senators test positive, well, that could mean they delay the vote timetable altogether. At the Tokyo Olympics, American gymnastics star Simone Biles made an emotional return to competition and ended up winning the bronze medal in the balance beam final. That came a week after she withdrew from several events to focus on her mental health. The bronze was Biles' 7th career Olympic medal. She won it by drilling a slightly watered-down version of her usual routine on the beam. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What you said was we need to make them in America. Does that include overseas companies making them if they have the plant in America?
I would certainly be in favor of them having operations in America, absolutely. You know, Samsung, TSMC, there are companies that are in allied countries, and you know, we certainly want them operating in America and producing chips in this country, yes.
So we have a significant chip issue, but there are other supply chain issues as well. As I know you're monitoring what's going on. Where have you seen other problems in the supply chains right now in the United States that need to be addressed?
Particularly in home building supplies, you know, lumber and all the related supplies, glue, adhesives. And you see it playing out. You know, home prices are high. If you go to Home Depot or Lowe's, you'll see prices are a little bit high. So, and that's all because of the lack of supply, just disruption.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're talking about a $550 billion package. Honestly, who knows where this is going to end up? I mean, the conversation changes week to week. But at this point, I think that the market's expectations for another large fiscal plan have been dampened to some degree.
That was Lisa Hornby, Schroders head of US multi-sector fixed income. Thank you, Tom. You were part of that. Tom Keene, Lisa Bramwitz, Jonathan Ferro, your equity market. You're on Real TK. Equity futures up 15. We advance 1/3% on the S&P into the bond market where yields are higher by a basis point or two. A breakdown yesterday, 119.38 this morning, still sub 120. Yeah. Euro dollar, Tom, positive 0.1% and change. Euro dollar 118.89.
And we haven't talked, John, yet about the curve flattening yesterday through 100 basis points. The difference in yield between the 10-year and the 2-year over less than 1 percentage point. And, John, we didn't get down to where we were like July 17th or whatever.
No.
But I'm sorry, it's a big deal to break 100 beats.
It's odd. I mean, we've talked about this so much over the last few months. Yeah. Guessing the data is one thing. Guessing how the market will respond to the data is quite another and really difficult to do. It was a downside surprise on the ISM, okay. But when you broke down the ISM, really robust demand still, some really subtle signs that supply constraints were easing. Those are the kind of things we want to see. I don't know, Tom. Yeah. What do you think?
Tom Purcelli wrote a note on that saying it was better than the gloom that was in part of
beneath the surface, yes, I agree.
Yeah. I don't
short squeeze. That's what a lot of people were saying.
Is that what they're saying? Still, Lisa, though?
Still, which is the shocking thing, the idea that there still are shorts to be squeezed out.
That's been the excuse for the last several months. Mm-hmm. Okay. I mean, I'll go there. Your 10-year 119.38. I'll go anywhere with this bond market right now, Tom. I've got no idea.
Jeff Fitzpatrick is like, what are they talking about? He's in Washington. Jack Fitzpatrick, our Bloomberg government reporter, and joins us this morning. Jack, I got to stay on plan here. There's always a wacko issue that comes in every summer in Washington. It's eviction, and I guess we can make a joke about it, but this is really serious, isn't it? Are there going to be people out on the street?
Yes, as it stands right now, there's not really much of a plan from the executive branch or Congress to deal with this. The president, speaking about this yesterday, did note that states are taking action to the extent that about 1/3 of the people who would be evicted are not going to because of their own state measures. But really, the list of things the president is trying to do in an announcement yesterday is not totally concrete, pushing states to take action, trying to get previously allocated money out. That has been a big deal.
Right.
Right now, there's not an extension of the moratorium, and the Supreme Court had made it pretty clear that the Congress actually needs to act on that, and the House is gone.
Well, that would be my Civics 101 is where's Congress? But is this a debate about this pandemic, or is this a debate about welfare and Washington going back to the days of William Jefferson Clinton?
This one, I think, is pretty clearly more its own issue today. It's not extremely ideological. Even on the Republican side, a lot of the criticism I heard was just that the administration sat on its hands and waited way too long to tell Congress that it needed Congress to act. And meanwhile, they tried to act to make everyone whole in these negative situations with landlords. But out of the $46.5 billion that was supposed to go out, as of late last week, only $3 billion had gone out. So it's really a bit of a mismanagement issue politically and in terms of spending money that Congress had allocated, much more than an ideological issue that I can tell.
Jack, I of course don't have a particular view on this. The unemployment insurance expires in September. I'm just wondering from your perspective, if there is a conversation brewing here about delivering more assistance once that does expire in September, given what's about to happen with evictions.
Well, the timing and the back and forth on the eviction issue makes you wonder, because the administration had initially said it would let it expire and then at the very last minute asked Congress to act. So that may not be a good sign for them standing by their exact plans. But the president has pointed out, and people around him have publicly pointed out, this is set to end in September. They plan to let it end. That kind of relieves some of the partisan debate that's gone on back and forth for months in Washington over what exactly the role of those benefits are in terms of the slow return of the workforce. So we haven't gotten anything specific showing that the president might change his mind on that. And I think the general expectation is that is going to end in September.
Meanwhile, we have the infrastructure debate ongoing with Lindsey Graham, the senator from South Carolina, being diagnosed with coronavirus, not able to join for the vote for 10 days as he isolates himself. He has been vaccinated. He is okay. That according to the reports, but he doesn't want to infect others. There is a question of how much flexibility there is, how much support there is with enough of the constituents to get this bill across the finish line before the recess. What's the odds, from your perspective, from the people you speak to, that they'll be able to plow forward regardless of Lindsey Graham's participation or not?
Right now, it's looking pretty good, but you do deal with narrow margins in the Senate. I'd point out the first procedural vote they took, they needed 60 votes, and they'll need 60 votes again, but they got 67 votes. I think the amendments upcoming will play a significant role. I looked through all the amendments filed as of yesterday. None of them were really controversial. At this point, they're taking votes on an untold number of bipartisan amendments that don't seem to threaten that many votes. But as you go through that process, somebody could get upset over something and you lose votes. But the fact that the starting point is essentially 67 and they need 60 is a pretty good sign, especially given that we haven't heard of anyone else testing positive. There was a party or a gathering, they said, on a houseboat. The more negative tests that come back from that, the better for them, because if a dozen people are affected, that's obviously a much different scenario. But as of right now, this kind of takes them down from 67 to 66, which doesn't look like a problem.
Jack, thank you. Jack Fitzpatrick, Bloomberg government reporter down in Washington, D.C. Tom, you're right to point out what's about to happen with evictions. We've gone through the numbers a couple of times. I'll do it again because I think it's worth it. This according to the latest Census Bureau survey. Now this has expired, this is what's at risk. An estimated 3.6 million households who've fallen behind on their payments are somewhat or very likely to face eviction over the next 2 months. About 7.4 million households are behind on rent in total. Tom, this all according to the latest Census Bureau survey, and those numbers are just horrendous.
Whatever your politics, the inability to distribute the funds shows a level of distrust in the process. And John, it's not just evictions, it's the underlying landlords that are hammered by certain bills. And even above them, some of these smaller banks, they're not JP Morgan. They can't do it out of petty cash.
If there's a debt, Tom, there's someone not paying and there's someone not being paid. And Lisa, that's the situation right now.
The interesting thing is also where a lot of these evictions may occur. And you can actually see that it's concentrated in southern states, in particular Mississippi, South Carolina, and Georgia, where they tenants are more likely to carry rent debt in the U.S. on average. Just looking at this, you wonder what the political ramifications are as well of those images of people being kicked out of their homes, John.
Yeah, a story that we need to stay on top of right here on Bloomberg Surveillance, on TV, on radio, alongside Tom Keene and Lisa Browitz. I'm Jonathan Ferro. Up 14 on the S&P 500, advancing 1/3 of 1%. Yields are higher this morning by a basis point and change to 119.21 on a US 10-year. And euro-dollar stronger, positive 0.2%. Euro-dollar 118.92. From New York City this morning, good morning. This is Bloomberg.
How do you assess the sector as a whole? Is it making a better case for itself at the right price at this point?
Most of the big hedge funds, most of the people that have been growing, have been delivering very good performance. We have, but so is a number of the peers. You know, it is definitely the hedge fund business is getting more about the large getting larger and generating more performance, being able to hire the best people, thereby generating better performance, thereby getting larger. So when you look at the performance of the largest, say, 20 or 50 hedge funds, the performance has been pretty good over a number of years, and the inflows have been pretty good. You know, this is another quarter of positive inflows for us. I think one of the bits you're seeing at the moment is every client is worried about inflation. When they say they're worried about inflation, what they really mean is, I own a load of bonds, is that going to cause me a problem?
I assume you have a lot of people saying the food isn't as healthy as they might want it to be. Is that the biggest challenge, or just growing the company?
Ray Kroc had a famous line, if you're not green and growing, you're red and rotten.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Live from New York City for our audience worldwide on TV and radio. It's the price action this Tuesday morning on the equity market. Futures positive by a third of 1% on the S&P. On the Nasdaq, up by a little more than a tenth of 1%. And some nice outperformance on the Russell. The small caps up by 0.7 of 1%. Coming into August with a broken consensus and a wide range of views. We've had a few of them on this programme already. We've had John Stolfus of Oppenheimer looking for 4,700 on the S&P and 3,850 the view from Anahan and Chris Harvey over at Wells Fargo. A wide range of views on the equity market into year end and on the bond market too. Switch up the board, 2s, 10s, 30s. Your 10-year yield right now at 118.88. You've got Steve Major at HSBC looking for that move, that relentless move, gravity almost, pushing us back to 1%, pulling us down on a 10-year yield. Then the likes of Morgan Stanley and others looking for a move back to 160 and beyond. That range of view extends from the Southside strategists all the way to the FOMC and the Federal Reserve and the Board of Governors itself. Two very different views on what to do next. Switch up the board. You've got the view from Governor Brainerd, patience, the view from Governor Waller and President Bullard, almost said Governor Bullard then, maybe the same person. They are two very different views. Here's the view of the market right now. Financial conditions loose, loose, loose. This from Mohamed Al-Arian in the last 24 hours. And I think the Goldman Sachs Financial Conditions Index is one the Fed has got to be looking at, Tom. Financial conditions. When this chart goes lower, that means conditions are getting looser. And that is record looseness for financial conditions in this economy, in this country.
Overnight repos, John, went back under $1 trillion yesterday, but it's something to watch. You know, there's a gloom crowd, a fear crowd talking about $2 trillion overnight repos. And I don't know if you get to that number, but the answer is the financial conditions are something we've never perceived
How
before.
much support does this market need in the environment we're in right now? And the likes of Governor Waller, the likes of President Bullard, Bostic, Kaplan,
They're going to
others.
wait for the data.
Tom, they've already seen the data. As far as they're concerned, we're not in an emergency anymore. This is loose enough. The work is done. Let's move on.
Others
Let's get the ball
disagree.
rolling. We need some optionality for 22. I'm with you, Tom. Others disagree.
Yeah.
I mean, what did Joe Lavorna of Natixis say earlier this morning? No hike through 24.
Come on.
Hike through 24.
Okay, that's an
Compare and
outlier.
contrast that with Stephen Stanley of Amherst-Pierpont, who's looking for a hike next year of June 22. And I started this conversation, Tom, by saying no consensus one and a wide range of views. That's where we're at right now.
Yeah, okay. When do we get the dots redone? I mean, they're going to be as
Next
silly as
meeting.
they are. Yeah, you know, next time around.
Looking forward to the coverage, Tom. I can see you're excited too. Just to get through August. Let's get you some
I want to
stock
see
movers.
the data.
Here's Romain Bostic with your movers this morning. Hey, Romain.
Hey, good morning, guys. Let's start off here with Alibaba. We did get earnings out of the company. A lot of folks, of course, were focused on the company because of the regulatory overhang here. At least right now, in the short term, there doesn't appear to be a huge impact. You're talking about a company with $32 billion US dollars in quarterly revenue here, and a company that still seems to be investing in its business longer term here. So whatever regulatory crackdown is going on over there on Alibaba, on Ant Group, and the rest of the Chinese tech sector, at least for this particular company, it doesn't seem to be upending its longer-term plans. Nevertheless, the shares down fractionally here on the morning. They've been oscillating between gains and losses, now down about 0.5%. Eli Lilly taking it a little bit harder. They did come out with earnings. Those shares down about 2%. Mainly this has to do with that COVID therapy. Remember, sales in the most recent quarter dropped down to about 150 million. That's down from 800+ million in the most recent quarter prior to that. Now a lot of focus is going to be on the company's Alzheimer's treatment, which of course is still in development. This is still a juggernaut of a company. You're talking about $27 billion in annual revenue projected for the most recent year ahead here. But again, that's still a little bit light from what the street was expecting. Also coming in light here is Clorox. They reported earnings. These shares down 8.5%. This is a company that really got hit hard. Remember, they benefited a lot from everybody disinfecting and doing everything during the pandemic. Sales came in way below estimates, and they're projecting a 2 to 6% decline in full-year organic sales here. This is for the fiscal year that just started in July. So this is a big deal. Keep an eye on that. Also keep an eye on Take-Two and the rest of the video game space. Last night, Take-Two did report earnings. They also missed estimates, both in terms of revenue as well as in their monthly active users. This is a stock also that the company that basically came out and said they're delaying a couple of games. They didn't specify what those games are, but the shares. I know this is going to be big in the Keen household, I'm sure. Down 4% here. Activision Blizzard reports after the bell tonight, Tom. Keep an eye on that. And of course, a lot of concerns here about Tencent and whatever the heck's going on China and those reports about the video game industry there. Finally, finally, Tom, keep an eye on Lyft. That's reporting after the bell tonight here. This is still going to be a money-losing company, so don't expect any profitability.
Romain,
yeah.
Seriously, are they going to talk about vaccinated, unvaccinated drivers? Is that on your radar for the close?
Well, they're going to talk about it, but here's what they're also going to talk about. Here's the deal, Tom. You're talking about a company that, despite the fact that they're losing money, despite all of the concerns, they're going to punch through 700 million shares. For the first time, Tom, they're going to have something like 15 million active monthly riders, however they measure that. And more importantly, Tom, they're talking about $45 per active rider. That's a big deal for this company that, of course, was below 40 just a couple of quarters ago. So they're getting more money out of their riders. So I guess that's a good thing. That means either we're riding more or riding further, or maybe the prices are higher. Who knows? But there's a lot here going on with Lyft. I tell you, most of the folks over at Bloomberg Intelligence who cover this, Mandeep Singh and that whole crew down there, they're pretty bullish on both Lyft and Uber with regards to ride-hailing, that ride-hailing business.
Romain Bostic, thank you so much to close this afternoon here in earnings season. This is an important conversation, and it may surprise you that it's our conversation of the day. We're trying to recalibrate equities and economics into the litmus paper of the system, which is yield. And John Farrow, you've talked about global yields as being as important in their interdependencies as the U.S. 10-year benchmark.
Yeah, let's get to Porrick Garvey on that, Tom. ING head of global debt and rate strategy. Porrick, all this talk about 10-year yields and they shouldn't be down here in the Treasury market. Then you look to Germany, and yesterday the whole curve below zero, beneath zero. Porrick, how important is that dynamic, the European dynamic, that gravitational pull, yield to lower?
Oh, it's absolutely vital. I mean, this is an incredible set of circumstances, but you can't get away from the fact that the Treasury yield is the global benchmark. And as we sit here today, we're looking at that 10-year heading towards 1%. And I think the big lesson here for Europe is that Europe never really recovered from the global financial crisis as measured by monetary policy. I mean, rates are still negative. QE is as aggressive as it's ever been. The only hope for Europe is that the US manages to repeat what it did post the great financial crisis, stop buying government bonds, raise rates, get back to some semblance of normality. So what I see in Europe is a loss of hope, because if the US can't do it, how can the Europeans do it? They haven't done it before.
A loss of hope. I mean, is that the message from the $16.5 trillion of negative yielding debt, the highest volume globally since February? Is this representing a loss of hope?
You know, you've got to break this out as to whether the market discount is telling us something about the future, or whether the market is being pushed there by an excess demand for fixed income. And I think it's a bit of both. In a sense, there is a loss of hope, because we've got to accept that the marketplace, the bond market, is a discount function. But at the same time, we know central banks are huge buyers of government bonds, persistent buyers of government bonds, and that's a major catalyst behind this fall in yields. Everybody wants to be on the same side as the central bank. And as long as central banks are buying bonds, that's the side you want to be on. Hence, we find ourselves in this incredible situation, very deviant from where macro circumstances are.
Park, you know, we're all talking yield here, but this is a time where I flipped a price, and the answer is there's a massive bid on all this paper. Is it similar to 2005 and 2006, or is there a different character to the bid, the insatiable desire to move price up on fixed income?
There's a whole series of players out there, Tom, that are buying fixed income. And, you know, it's not just guys buying bonds. It's also corporates setting up fixed rate receivers where they swap from paying fixed to paying floating, because they feel that by paying floating, they're going to get the cheapest funding, and the prognosis in terms of rate hike risk is really quite dim. So what I see is an excessive demand for treasuries. We see a lot of buying out of Tokyo, for example. And, you know, I've said it before, if you're sitting in Tokyo, you don't care what US inflation is, as long as it's not affecting US yields. And that's just, I mean, if the simplest explanation for where we are is an excess of demand of supply for fixed income. But it poses problems. The Fed have not spoken about this, but they will not be happy to see the 10-year approaching 1%. It makes life very difficult for them.
They should stop buying tips then, shouldn't they, Porrick? And we'd stop talking about real yields, wouldn't we? wouldn't we have an adjustment there? I mean, I'm asking you the question how distorted that market is right now.
Well, the entire spectrum of rates is distorted. I mean, minus 100 basis points is an absolute distortion. 1% potentially for the 10-year is a distortion. And here's the thing. The Fed wants to hike rates. Not now, but they will want to hike rates. You can't hike rates with the 10-year at 1% because you're just going to invert the curve.
Yep.
So they have an issue. They want to get that 10-year up to 2% ideally. The way to do that here and now is don't taper, just stop buying government bonds. Will they do that? Unlikely, but that's what they probably should do.
Porrick Garvey, it's good to catch up. ING Head of Global Debt and Rate Strategy. TK, this is the issue right now. You can say it's distortions and technicals, but eventually they become fundamental narratives. Price shapes narrative, and then this story, this theory of reflexivity starts to emerge. It's a market that shapes the weather it anticipates in many ways, Tom, and this is an issue, I think, for the bond market going forward from here.
We could get philosophical here, folks. Reflexivity is owned by George Soros back to Karl Popper, and John, you're absolutely dead on, and that it is an ex-post central bank. And then what Popper weaned in the early 1950s and George Soros picked up on is the narrative changes, and that changes your interpretation to the ex-post view. I hope I got through that in one piece.
Porrick just said it for us.
Yeah.
This Federal Reserve, even if that bond market move is just full of distortions and technicals, it could stop them from hiking interest rates because they don't want to hike interest rates if they're going to invert the curve.
On radio and TV, I can only say it is just an honor to deal with John Farrow on economic epistemology, the British way, and reflexivity.
Thank you, Tom. I'm not sure how authentic or genuine that was. Tom Keene, Lisa Bramwich, Jonathan Farrow. Equity futures up 15, up a third. Mistraining again. He's missing. The Italians say he's found in Giorgio Chiellini's pocket. I'll leave that there. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden and top White House officials are trying to stave off a wave of evictions. A federal moratorium on evictions just expired, and the president is pressing federal, state and local government agencies to act quickly to stop tenants from losing their homes. The chair of the Securities and Exchange Commission is preparing more oversight of cryptocurrencies to protect investors. Gary Gensler has unusual expertise in digital assets, but in an interview with Bloomberg, he signaled that he's not on board with the hands-off oversight approach that many enthusiasts would like to see. He says that investors must be protected against fraud. Standard Chartered overcame economic headwinds across Asia to beat second quarter forecasts. That's allowing the bank to buy back shares and plan a small dividend. We spoke to CEO Bill Winters in an exclusive interview.
We'll then have plenty of capital to continue to invest either organically or inorganically. So if we get some interesting acquisition opportunities along the way, we'll have the capital to do that. If it turns out that there's nothing out there for us to invest in, which would be a bit disappointing, then of course we could resume buybacks or increase the dividend.
And Standard Chartered is expecting full-year income to be in line with what it was last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
We can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature, it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Some of the best deals in history have been passed on by a very large number of people. The money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
For the people here on Earth who are wondering why are we investing all this money in space, this time in space, talk to us about how you believe this will actually help benefit us here on Earth.
We're building infrastructure. This is a road. We're building a road to space so that future generations can build the future. We live on this beautiful planet. It's the most beautiful planet in the solar system by far.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
As of Saturday, CDC reported the 7-day moving average of daily new COVID-19 cases to be about 72,000 cases per day. This represents an increase of 44% from the prior 7-day average and higher than our peak of last summer.
Rochelle Walensky there, the CDC director. The important component, of course, the relationship and the change relationship between those cases, hospitalizations, and ultimately deaths. We can talk about that in just a moment. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's your market up 16 on the S&P, advancing 0.4%. Yields are higher by about a basis point. 1 basis point higher to 118.71 on 10s after yields broke down through the best part of yesterday's session, the latter part of yesterday's session. One name to watch in the pre-market, Lilly down mildly. It's a mild move lower by about 1.67%, Tom. I'll just rattle through the numbers, Tom, and give you the forward look as well. Second quarter adjusted EPS at 187, the estimate 189. Second quarter revenue 674, 6.74 billion, the estimate 661. Just a forward look here on revenue, Tom. Full year revenue 26.8 billion to 27.4 billion. Had seen 26.6 to 27.6. So no big moves in the mix here, Tom. Just a subtle move lower, down by 1.67%.
This is a joy, and it is a joy, John, when you are weaned out of Indiana, as part of my family was. David Ricks is with Eli Lilly, their chairman, their chief executive officer, celebrating his 25th year with the company. The Ricks era, going back to his first day darkening the door, is 12% per year. In the last 10 years, the stock is Home Depot and Apple-like up 24% per year. It has been an extraordinary move. David Ricks, I want to talk about where you are now with COVID. There's some sensitivities here with the antibodies and that. When you're meeting with your head of research and science, Daniel Skowronski, as well, when you look back at the last 18 months on COVID and you look forward to the next 18 months with this horrific pandemic, what have you learned and what's the to-do right now for Eli Lilly in this horrific pandemic?
Yeah, Tom, thanks for having me on. And Dan's a key partner for us. And as a science-driven company, you know, those meetings happen a lot, as we were talking offline. COVID, we've had a lot of ups and downs with COVID. You know, last year we had a lot of unknowns about how this would progress. And we set to work to create therapies, because that's what we do. We're not a vaccine company, that could be helpful. And we did that. I think we're very proud of that. We launched neutralizing antibodies, both a single and then a combo. And we also have developed one of our anti-inflammatory medications, Olumiant or baricitinib, which actually today we read out results that in those on ventilation or ECMO, the most advanced patients in the hospital, reduced death by over 40%. But we just wanted to, you know, put our tools to work to be helpful. You know, our ongoing business is about treating other diseases. We're not a virology company. And so as the pandemic has ebbed and waned, those businesses have come back strongly as treatment for diabetes and cancer has improved once doctors' offices open. You know, we don't think about ourselves as a COVID company, but we were happy to make a big contribution. And this year, you know, that ended up in a fair amount of sales. Although in the second half, you mentioned the guidance being narrowed on the year. That's really about reducing COVID-related antibody sales and increasing the performance of our underlying business. We do expect that as these waves happen, they'll begin to subside. Each one will be lower, and a new sense of normalcy will set in. Right now, we have a problem in the U.S., but you know, we think there's a way to fix it. Get everyone vaccinated.
Dave Ricks, tell me about Alzheimer's. The absolute uproar in Washington about the need for a solution, the whole FDA thing. I get that, fine. You guys going back to insulin get these horrific diseases correct. What are you going to do to help our listeners and viewers with Alzheimer's?
Yeah, thanks. This is an area that's very personal to many of us at Lilly, and our scientists have been working for over 30 years to try to create a medicine that could slow the progression of this disease. You may know this, but it's the 6th leading killer. It's a fatal disease, and it's the only one in the top 10 without a medication that slows it down. Recently, the FDA shifted their policy. They said, look, showing an ultimate benefit in a slow-moving, difficult disease that we don't fully understand has been hard to approve drugs on, but they moved the line.
Excuse me for interrupting. This is really important, Mr. Ricks.
Yep.
Do you support that shift in FDA policy?
So, look, the regulator needs to make that decision about risk and benefit, but of course, we believe that amyloid reduction leads to slowing of the disease. We've been betting on that for some time and put billions behind it in research, and now we have a leading product in that area, donanemab, which had the first ever clinical trial in humans read out positive in Q1.
Dave.
So we have launched a bigger study, and we said in Q2 we're planning to submit this year under that new policy. And we think patients deserve access to that medication, but we're going to prove its worth just in the following year. We have a huge study going on that we just said is almost enrolled and will prove that benefit.
Dave, the Biogen drug was incredibly controversial when it came out, in large part because of its price, in addition to the FDA policy, which did seem controversial even within the FDA panel. How do you plan to be different with your Alzheimer's drug in terms of the controversy, in terms of the pushback, and frankly, in terms of the price point?
Well, we're not going to announce the pricing today, but I'll just point out, I mean, we tend to compete aggressively in all the markets we're in, and that benefits patients. And we compete by creating better molecules, better medicines themselves with different properties. In this case, our medicine works very rapidly to clear plaques. By 1 year, almost the vast majority of patients in our study no longer needed to take the drug. They had cleared all the plaque in their brain. That's different from all the other antibodies being studied, which are really lifetime therapies. Secondly, we compete on data, and this is important here, and I think the source of the controversy. Few argue that the approved drug might have worth. I think the big argument is, did they prove they had worth? Did it really affect the disease? Of course, we are committed to complete the study that's now basically enrolled. We'll finish enrollment this quarter.
Yeah.
And we'll have that data in 23, which is pretty short period of time in the trajectory of drug development. And finally, we will compete on value in the marketplace. And when we hopefully get our approval sometime next year, we'll talk about our pricing strategy.
Dave, just quickly, a minute on the clock. Are you requiring your employees to be vaccinated?
Not at this time. We're not. We believe we have very high rates of vaccination in our population, but we're tracking that issue very closely. And of course, new information just released in the U.S. about the transmissibility of the Delta variant from those that are actually vaccinated is of concern. We're analyzing that as we look at our policy. To date, we've had very few, if not zero, in many of our facilities transmission of the disease.
Yeah.
And so it hasn't been a real problem for us in running our business, but we want to look at that and stay abreast of the latest information.
Dave, it's good to catch up and get your view this morning. Dave Ricks, Eli Lilly Chairman and CEO. You as well, sir. From New York City this morning, good morning. Your equity market pushing higher by 16 of 0.4% on the S&P 500. From New York City this morning, good morning. Alongside Tom Keene, Lisa Brabitz, I'm Jonathan Ferro. Heard on radio, seen on TV for our audience worldwide. This is Bloomberg Surveillance.
So this year, E3 is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
The video game industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Had an exceptional Q2.
It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Once the market really starts to doubt the potential for reflation, the potential for growth, that can kind of spiral out of control.
There's always pullbacks, and mini corrections, maybe even a correction ahead.
The market kind of has this view right now that if the Fed starts hiking, they will not be able to get many rate hikes actually done.
I would argue the labor market is as tight, if not tighter, than any we've seen in decades.
I'm more worried about growth in 2022, and that's what the U.S. bond market and global bond markets are sensing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. It's a simulcast, a Tuesday simulcast, radio and television. Esteemed guest coming up, particularly equity market. We really looked a lot at the stock market today. And John Stolfus got us going. I mean, John, take it out. 4,700 on to 5,000. That's a Dow 39,000 equivalency.
Thanks, Tom. I'm sure they've got a Dow year-end price target over at Oppenheimer too. Not. Your equity market up 16 on the S&P, up 0.4%. In the bond market, TK, you and I, Lisa too, we've been talking about this broken consensus in the bond market. It's in pieces after July and a 25 basis point move lower on the 10-year. And I wonder, Tom, to what degree, to what extent a consensus remains on the Federal Reserve as well, and whether Chairman Powell is really struggling here to reflect one that may not exist.
Okay, that may be true in economics, John, but take it back to Fibonacci 101. If the yield is telling us something and the bid up in bonds is telling us something, you flip the reciprocal, and that's how you get the Dow 40,000.
What is it telling us? Away from the Dow talk, what is it telling us? Can we agree on what it tells us? Does it tell us that the Federal Reserve has a massive presence in this market? That they hold 25% of the TIPS market? Does it tell us that the hopes for better growth through Q1 have basically been diminished by the fears of decelerating growth through the year ahead and into 22? I have no idea. You pick 5 strategists, I'll get 5 different reasons as to what's going on.
And somebody on the Zeitgeist mentioned the 10-year in Japan didn't trade yesterday. Lisa Abramowitz, your thoughts on all this, and bring it in away from full faith and credit bonds into what you're observing in IG and in high yield.
Basically, the Fed's put that has been ongoing, as Bill Dudley even said, was the main dominant factor in yields being as low as they are, is trickling over to the credit side, companies refinancing at the fastest pace ever. I think we were really framing the debate well, both you and John, earlier today when you were talking about, can the Fed raise rates and move away from their stimulus if everybody is buying into it and following them? How disruptive, Tom, will it be for them to change course if everyone is just saying, we don't want to fight you, we're on the same page with you, and that will necessarily lead to a correction that perhaps the Fed's not prepared for right now?
John, do we change the parlor game over the Fed when we see a headline that Tyson Foods will require vaccinations from the U.S. workforce? I'm sorry, that filters into our game.
Let's frame it broadly, then we'll get specific.
Sure.
We've talked about August as the path through to September. Why? Because September, we're waiting for this supply-side response, more people coming back to work, easing some of these supply constraints. That's why how we respond to this COVID variant, the Delta variant in the coming month, is so important, and that's why this headline matters more specifically to the likes of Tyson Foods, Tom. So let's rattle through them together. They're going to require COVID-19 vaccinations for the U.S. workforce. Almost half of the U.S. workforce has been vaccinated. Infection rates among team members remain low, and they've given a date, Tom. All team members required to be vaccinated by November 1st.
Okay, so
worth pointing out a couple of things: the size of the workforce and the nature of the business. 139,000 It's a big workforce, Tom. The nature of the business, when you think about that, I think this decision speaks for itself.
November 3rd, also a Fed meeting. Maybe that's a small coincidence as well. John, let's get through the data to get to our important guests. The VIX 18.70, futures up 16. Equity markets giving me a lift, maybe small cap doing better.
Yield to 118 on a 10-year, Tom, basically unchanged. They were higher by a basis point or two. We're now going nowhere. Talked a little bit about foreign exchange already this morning, Tom. If you tell me how this market responds to the data in the bond market, I'll still have difficulty telling you how the FX market will respond to the bond market. So there you go. It's a challenge for anyone operating in financial markets at the moment, except for those that just said, you know what, start of the year, I'm going to buy an index, the S&P, the NASDAQ, and I'm going to sit there and do nothing for the year. And then let these conversations go along around me. And the Dow, if you want to as well, Lisa. I imagine there are some products out there.
There are a few
that you can buy to get exposure to the Dow index if you want to.
How generous, charitable.
All right?
Yeah, very good. Joining us now on the Dow Jones Industrial Average, Michael Holland with Holland and Company and their chairman, knowing that the Standard & Poor's 500 is more indicative of what's going on. Michael Holland, I want to ask you a Lou Rukeyser question, and I say this with great respect to the sweat of Wall Street Week years and years ago when fear was ascendant. The way we solve fear in our equity ownership is to extrapolate out what successful companies do. How far out are you extrapolating right now on the companies you believe in? Are you out 6 months? Are you out 6 years?
More like the years than the months, Tom, but I think there are fewer and fewer companies that one can zero in on and say, I think this is worth the risk of losing money because the potential for the upside is so significant. There is enough cacophony around about the economy, the Fed, China, COVID, and on, that companies like Tyson, which you were just talking about, are indicating the world continues to change under our feet. Yet in the markets, because of the tsunami of cash that has come over the markets over the past few years, we have pricing that we've lost price discovery. We've lost real rates of return to use, risk-free rates of return to use for econometric modeling. So the Fed is flying as blind as the rest of us.
Interesting to me, Michael, how willing investors seem to be just to isolate a problem. A problem emerges, they can put it over there to one side and say it won't bother us too much. And a great example of this, you mentioned China. This is what Dan Ives of Wedbush had to say. My producer Jamie pinged this across to me in the last couple of minutes. This is what Dan Ives says. We believe these dynamics will yet again bode well for US tech stocks as the favorable backdrop and rotation away from Chinese tech into US tech creates an Nirvana setup. So, Mike, we used to say a couple of years ago, what hurts some would hurt everyone because we're all buying the same basket of goods. Now we've got people saying what hurts China will actually benefit US tech. Let's rotate even harder into them. What do you make of that dynamic?
Well, the dynamic is reflective of a market that has gone inexorably upward, Jonathan, over the last several years. And I think the looking for the positive outcome is something that I'm always prepared to do. But in the case of China, I think it would be a fool's errand to ignore what's going on. There was a wonderful piece in Bloomberg Intelligence yesterday on the terminal about the thing that's different about China today, in contrast to the last 40 years, most of which I've spent going over there, is that they now remember that they're communists. And when they remember they're communists, you end up with a situation where you're not doing things as they've been doing for the last, which created Alibaba, which created the opportunity for people to make tons of money. They're now becoming political and warrior-like.
So, Michael, fold that into an investment thesis. If price discovery has gone away, if we have China that matters more broadly, what are you doing right now?
Being very careful, and Lisa, and actually we've kidded before about the all-weather portfolio, but I think as the three of you opine daily, there are things that don't make a lot of sense, can't be explained in terms of where prices are. You have a 5% earnings yield, the flip of the reciprocal of the price earnings model on the markets in the U.S., and less than a 2% 10-year Treasury with inflation looking like it's going to be sticky at somewhere around 4 to 5 to 6, or maybe 2 to 3 to 4. But these things don't make sense. So what I do is try to identify properties that are useful. Tom asked a question about weeks and months, or Jonathan as well. You buy properties I would say that companies like General Motors, which I've been looking at recently in the last several months, have a plethora of things that could go right, but a valuation that doesn't reflect the overall market. So the risk, but there are fewer of those. They're just, it's hard to do.
Michael Holland, do you do some of the parts analysis on companies that have different sections? They're not Ling Temco Vote. Michael, you and I are the only ones listening or watching that know what LTV is. But if they're not Ling Temco Vote, do you still do some of the parts, say, on Amazon, Apple, or some stock I don't know?
Yeah, absolutely, Tom. It's interesting that you even have to ask the question, because that's what value is. If the three of us, the four of us, I should say, we're looking at something to buy in the private market, we'd look at what is it worth? What are we willing to pay for it? And in the public market, people have gone away from doing just what you described. Jimmy Ling and the LTV crowd figured that out a long time ago. But prices were so low back then, in a lot of cases, that you could find out that if you looked at, let's use General Motors today. If you looked at the different kinds of businesses there in technology, any individual one of those a few years from now could be worth a gazillion amount of money. But they're trying to do that to further the businesses. But yes, you do still have companies like General Motors that afford that opportunity to look at maybe some of the parts is really worth a lot more than what the market's paying for them. But not too many of them anymore.
Mike, you're a legend, and it's always great to catch up. We appreciate your time. Michael Holland there, Holland & Co. Chairman. Let's reiterate that headline of the last 10 minutes. Here's a company that's not bothered by the politics. It's looking at the science, and it's made a business decision. It's Tyson Foods to require COVID-19 vaccinations for its US workforce. The problem we have right now, Tom, tons of demand, supply problems, worker absenteeism. And a company like Tyson Foods is looking through winter and wondering what happens to their production capacity, what happens to their ability to make sure they've got the adequate supply of workers in the business, Tom, and this is how they're trying to tackle the issue.
And there's a southern cast to this out of Springdale, Arkansas, that will be part of this analysis to their November 3rd date.
Providing $200 to fully vaccinated frontline team.
There you go.
There you go. Up a third of 1% on the S&P this morning.
Yesterday.
From New York City. Good morning.
1,000.
Alongside Tom Keene. Lisa Abramowitz wants it to be 1K.
No, I didn't.
And
He
not
did.
$200. Tom said 1,000.
That's what he said
Are you
yesterday.
correct in TK?
Well, he was saying 200.
Why not?
Are you keeping notes?
Yes.
Future's positive. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The surge in COVID cases is increasing pressure on U.S. drug regulators to fully approve the Pfizer coronavirus vaccine. It was the first one to apply for the full licensure in the country. Approval could help the Biden administration ramp back up its immunization drive and reassure vaccine holdouts that the shots are safe. Alibaba posted quarterly revenue that missed estimates. That's suggesting plans to hike spending in pursuit of growth have yet to gain traction. Meanwhile, the Chinese e-commerce giant said it was increasing its share buyback program by 50%. That's to $15 billion. PepsiCo will sell its Tropicana juice brand to a private equity fund. PAI Partners will pay $3.3 billion for Tropicana, Naked Juice, and other juice brands. PepsiCo will retain a 39% stake in the new joint venture. Juice sales have been under pressure because consumers are cutting back on sugar consumptions. And at the Tokyo Olympics, American gymnastics star Simone Biles made an emotional return to competition and won the bronze medal in the balance beam final. That came just a week after she withdrew from several events to focus on her mental health. The bronze was Biles' 7th career Olympic medal. She won it by drilling a slightly watered-down version of her usual routine on the beam. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
If inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
I assume you have a lot of people saying the food isn't as healthy as they might want it to be. Is that the biggest challenge, or just growing the company?
Ray Kroc had a famous line, if you're not green and growing, you're red and rotten.
How are you navigating what seems to be a really tough situation better than almost anyone else?
We've worked hard on the supply chain. There's no question there's a lot of work to do in the supply chain for semiconductors. And we're happy that we were able to exceed our second quarter guidance, as well as, guide up for the rest of the year.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary.
I think you are seeing, not just inflation data, but you are seeing inflation present in virtually every corporate earnings call that you hear about.
That was Michael Schau there of Marketfield Asset Management, the CEO. From New York City this morning, good morning. Alongside Tom Keene and Lisa Browitz, I'm Jonathan Ferro. Your equity market picture looks like this on the S&P 500 this Tuesday morning. We advanced 12 on the S&P, up a third of 1%. On a 10-year, yields unchanged at 118.05. And some updates for you. Tyson Foods coming out and requiring its staff to get vaccinated by November 1st. The McDonald's, Lisa, in just the last minute or so, they're pushing forward as well.
Yeah, they're saying that all customers and staff will need to start wearing masks again, mandatory masks inside its U.S. restaurants and in areas specifically with higher substantial transmission of the Delta variant of COVID-19. But it just shows, John, how the private sector very much leading the way when it comes to tightening protocol going forward with this pandemic.
Those decisions coming in the last 24 hours, just unbelievable to start to see corporations respond to this through last week and into this week as well. One name to look at related to this pandemic, Clorox in a pre-market down by more than 11%. I'll rattle through the numbers for you. See second quarter, or rather the year ahead, see sales 2 to 6% decrease. 2022 organic sales down 2% to 6%. Tom, it goes on, adjusted EPS $5.40 to $5.70, the estimate $7.60. It's a miss as well on net sales at $1.8 billion, the estimate $1.9. Adjusted EPS coming in at 78 cents versus 2.41. $2.41. And it's pretty clear what's going on here, Tom. Monster pull forward last year. People have still got this stuff in the cupboards. And as Lisa and I both said in the commercial break, this is the end of hygiene theatre in a big way for many people. That stock down by 11%.
Yeah, 8 standard deviation move. Really, in the churn that it's been in recently, it's a huge move. John, it's round trip. It's really pretty much back to where it was Valentine's Day of 2020. I mean, you wonder, are we going to see more of these?
Down 11%, Tom.
Yeah,
we're down to, where are we? 161.23.
Well, we will see. So there's the stories of the stocks today, and of course, all of this very much moving. Part of it moving is a technical nature of what we see in the equity markets. Jonathan Krinsky with us now with Baycrest Partners. I'll get it out. Jonathan, I love your note because you go back and you say, look, small caps, I miss that. You look at large caps, and you fall in the center. What's the value of what nobody's talking about right now, which are the stocks in the mid-cap space versus the juggernauts of the world, or all the fever over small caps?
Yeah, there's this ongoing battle between small caps and mega cap tech, and you can see it even on an intraday basis where off the opening bell, small caps will rally, mega cap tech will sell off, and then it'll flip on a dime and just completely reverse. And that battle can be seen, on the intraday charts and on the daily charts as well. But yeah, I think the mid caps are an interesting group here because they don't get a lot of attention as far as the index itself, the S&P 400, but it's been doing a bit better than the small caps, and it's a bit further along in its upside breakout. So we think, take your eyes off the small and large and look right there in the middle. There's some really good opportunities.
Jonathan, what does the technical strategy of melt up again, and melt up yet again look like? I mean, I'm looking right now at a Bank of America metric, basically saying that there is almost a contrarian sell signal based on how many people are bullish, and then even more bullish because what could potentially end this rally?
Yeah, well, that's what happens when you don't have a 5% pullback in the S&P for, I think we're going on 9 or 10 months now. And that's really the paradox of the market, right? Because on the one hand, we know that, markets tend to get at least a 5% drawdown almost every year. So, the clock is ticking there. On the other hand, in markets, when you go this long without that 5% drawdown, it tends to persist, right? We saw the entirety of 2017 go without a 5% drawdown. So we're really in this battle here, and we kind of use the analogy bull in a china shop for the current market because it is a bull market for the S&P anyway. And long-term breadth is pretty good. If you're looking at metrics like percentage of stocks above the long-term 200-day moving averages, those metrics are still really good. But we know there's this violence going on, in these rotations under the hood and on the sector level. We saw it in Chinese equities recently. Chinese internet stocks lost 55% off the top.